Afternoon. How are we all doing? Where's my camera? There it is. Afternoon, Peter, Crom, David, Reverend. How are we doing? What a day. Euro pound hit ADR. Busy. So I'm just trying to find my pen. Oh, why has it moved over there? Somebody's been playing around my thing. Afternoon, Nimac, Dougal. So yeah, nothing much moved today at all. Apart from euro pound. The pound's had a bit of a drop today. Well, had a bit of a drop, I should say. It's recovered it all. So I'm running a back test at the moment. Let me just move that down there. So yeah, not a lot of anything really. That was the start of the London session. We had news. V-shaped recovery. So yeah, nothing's happened today. Apart from euro pound, we had a bit of a weak euro at the beginning of the London session, and obviously as we had a week, it wasn't that weak actually, but as we had a weak pound, we managed to just about get an ADR hit. So 5-minute reversal on that. I didn't even get it. Look, it's that bad today. Didn't even get a reversal alert. Look on that ADR hit because it was just parabolic buying all the way up to ADR. And then straight back down. So utter rubbish. Afternoon, Tammy, Monkey, Bogdan. So yeah, as you can see from euro pound as an example, it's dead. Has been dead for the last week. Yeah, we've just not gone anywhere on anything. So I'm stuck in Aussie dollar on my other account at the moment. I'm stuck in this Aussie dollar CAD. I got out on this account. My other account's got an Aussie CAD short on. This thing's, I mean, it's just flatlined. I'm also in Aussie dollar Swiss and New Zealand dollar Swiss. It can't do anything with this market at the moment. It's just dead, absolutely dead. Just sideways. I've never seen anything like it. It's just, look at this week. Literally, every pair. All we've got is just a tighter cumulative range. I'm hoping they're waiting for CPI tomorrow. And as soon as we get that CPI number in, they might have an indication what happens with the US dollar, and then they'll kick some money into the market. But at the moment, it's just dire. Can't do anything with this. Look, it's just flat as a pancake. New Zealand dollar CAD. So saying, you know, everything's the same. We're just stuck. I've been watching my P&L for the last 2 days, just flicking up and down. Yeah, so I didn't bank anything yesterday. I had an opportunity to bank yesterday. I've had an opportunity to bank today, but nothing's got anywhere near bankable. It's just doing that. So I just can't bank anything. I can't do anything. Awful. Awful. Anyway, does this sometimes. Afternoon, Virginia, Amy. So today we've got obviously in just under 10 minutes CPI. This morning we had the Aussie. Sorry, no, we haven't. We got PPI this afternoon. This morning we had the claimant count change for the pound. That was massively, well, not massively bullish, but it was bullish. So earnings are going up. The claimant count change came down, so less people looking for unemployment benefit, which is all good, hints towards good unemployment numbers. So literally, obviously, because it was a positive reaction, a positive news event, the market collapsed the pound, and that's rallying it back up to where it started. So that's it. All we've had this morning. I'm not expecting too much, to be honest, off the PPI numbers this afternoon. It's very unlikely that the market is going to do anything until we get that CPI number coming out. So the producer price index is basically kind of like inflation for the manufacturing industry, or for producers basically. So any manufacturing company that takes raw materials and makes something, this is basically their costs. As their costs go up, our costs go up, inflation rises, blah, blah, blah. So it has a knock-on effect on CPI. If this goes up, typically the price that we pay goes up. If that goes up, interest rates go up. Yeah. And obviously the whole market is moving on interest rates. So this does go into the mix, which is why it's red. Somebody asked this morning why the Swiss PPI number wasn't red and it's orange. It's because the Swiss don't make anything. It's banking. So they have nothing much that they produce and export. Therefore, their PPI numbers are not important. So this is why you pay attention to what's on the calendar. Basically, if something isn't important, it's not usually red. Doesn't mean it can't move stuff, but just doesn't most of the time. We've also got Powell speaking this afternoon. So I doubt we'll get much out of him this afternoon ahead of these numbers, but I'd be very surprised if he dropped any hints as to what's going to happen with these numbers as well. But you never know. We could have something happen this afternoon. But today, blue crap. I want to turn this off. All this blue crap. So today we did have some OPEC news as well. Where's oil? There. Nothing happened to oil. So we did have some news yesterday. Or was it this morning? Sorry, I'm losing track. Yeah, this morning from Pill. So basically, I think this is why the market came down today rather than the unemployment, because Pill came out and said we could cut rates while leaving our stance restrictive, i.e. there's a good chance that we'll drop the interest rates. But he said it's not unreasonable to believe that over summer we will see enough confidence to consider a rate cut shortly after that. So basically rates coming down, we know that. Not until summer, we know that. August. So there's nothing in there really from what Pill said this morning that should really drop the market or pump it or do anything. It's just stuff we already know. Quite a lot of OPEC news come out, but no news on the oil, no moves on the oil. So that was your news. Other news today, the yen is recovering dramatically. We are now basically 50% retraced. We're closer to the all-time high now than we are to the bottom of that second intervention move. Yeah. So this US dollar yen, we're now 450 pips up from the low, and we're only 360 pips away from that all-time high. So this second intervention isn't working at the moment. So I'm keeping my eyes peeled on Financial Juice to see what the Bank of Japan are going to say about this, because this is not the desired effect. This is correcting. And ideally, they want that below 150. It only got down to 151 and it's bounced now back up to 156. Not working, is it? So I think there's a possibility of them having to do another move. And if you look historically, they have done that. That's what happened last time. So what we got rather than a rally like this was more of an accumulation last time. So So this was the intervention. That was the second kick they had to give it. So that was the first intervention which failed. This looks very, very similar. This price action we've got here, looks very similar to what we have at the moment on that second intervention. That was the second intervention they did at that time, which was the one that worked. We sat and stagnated for 2 weeks, but we didn't do a grindy recovery like we did there. We sat and accumulated with decent volume for 2 weeks before they really hammered that home. So I wouldn't put it past them watching this going, guys, you're not doing as we're telling you. And having a third put in. We're in second week, so there's a chance it could happen this week, next week if they're going to do it. But it's not moving, is it? So we'll wait and see what happens on that yen. But all the yens have completely unraveled, look. The New Zealand dollar yen, we're back to where we were when we did the intervention. So there's potential for another move on this, I think, this yen. But, you know, we're in unprecedented times at the moment. We don't know what's going to happen. Whether that was their last shot and it's failed, don't know. They're in a death spiral. We know that. They've been in that for a long time. Is this death? I don't know. But certainly can't seem to make any progress, can we? Back to the downside. So beautiful short if it's going to happen. Very similar to the one that I got there. It was a lucky trade. Nothing wrong with luck. So, yeah. But we'll see. We'll see what happens with it. Right, let's watch Euro US. News is coming out in 1 minute. Afternoon, everybody else. It's time. Gina, Segar, Neo, Callum. Aussie dollar New Zealand on the weekly. The last couple of times it touches those levels, it collapsed in 2 weeks. But this time it's just holding up there. Everything is holding at the moment. Bit of strength coming in on the US ahead of the news. 30 seconds. Everything's holding at the moment. So we'll see. I've got a TP on this down here. I doubt I'm going to get that hit. Yeah, let's go for an ADR. Why not? I can always close it manually. Yeah, everything's holding in it. We'll have a look at that Aussie New Zealand in a minute. There's a few RSIs to look at today. We'll go through. But apart from that, there's nothing much else. It's positive US. PPI numbers are up. Interesting. I'm just going to close that Euro US out just to put something in the bank because I've got double exposure on the US as well in the form of the US dollar CAD and the New Zealand US. So I don't want to keep too much exposure on the US in case this is a whipsaw and just reverse. But so numbers are positive. I'm going to switch over. There we go. 0.5. So forecast 0.2, 0.3. We got 0.5, 0.5. So pretty much double forecast. Very big number. As I said, the reason I banked that trade there was because there's a good chance that it will do that because we're waiting for this. So, yes, we've had a knee-jerk reaction. Yes, it's positive. But do we want to hold a position on the US dollar ahead of that number? If it comes out the other way, the banks are going to go underwater. So we'll see what happens. We might get a move, but equally good chance of that. So we'll see what happens. But that is positive US. Just want to get something in the bank today, basically, because it didn't bank yesterday. So it's still big spread at the moment. So there's a lot of volatility coming in, but it is undoing that move. So pound US dollar, same thing. Same on Aussie US. So this might be an initial order retracement and they'll basically add into that move. It could be a complete nonsense and we'll just come straight back up here and then we'll sit around for the rest of the day waiting for CPI tomorrow. So wait and see if they follow this through. But at the moment, doesn't look like it's got any legs. I wanted to take that off today because I've had so much opportunity to bank over the last 2 days and I haven't taken any of it because it's been like half the way, 3/4-ish the way to where I want to get out. Just not able to get anywhere. So stick something in the bank. Let's have a quick look at that Aussie New Zealand while we're waiting for that to decide whether it's going anywhere. Yeah, I mean, it's just stuck again. So we did get the breakout to the downside. It's kind of like an expanding wedge flag type thing. So it is bearish. So market structure obviously is held. So this is your lower high at the moment. We need to break this double bottom here to get a confirmation that, yeah, we've got the bears in control still. You've got a reversal alert followed by a reversal alert on the hourly there, which obviously indicates it's going sideways. So, but that is holding. So the initial propulsion move we had off the news, which they retested and added to get that break, they haven't got back to that level. So there's a good chance this is coming down from here, but I'm not sad I got out there with that loss. I'd rather just be out of this thing because it's same as everything else, isn't it? It's just stuck. Everything is stuck. The whole planet is waiting for those interest rates from the US, which is why tomorrow's number is so important. This is the data that says, I think, are we doing it this year or not? If we're not, that US dollar's going. So this is a really critical, which is why I don't think we get a reaction off of this today, regardless of whether that's the most amazing number in the world ever. This is the number. So I don't, nothing's really got any chance of getting anywhere at the moment. Beautiful double top on the CAD Swiss look. Which was short, but don't expect to get an ADR out of it. All you can take. Got no ADRs off that news either. So, yes, undone the move at the moment. We'll give it another 10-15 minutes and see what happens, but that's just completely retraced, just a whipsaw. Didn't even get down to yesterday's low look. Glad I got out of that one. Right. So other than that, that's the news today. It is bullish US. So we'll wait and see what they do with it. But Powell speaking this afternoon. Let's just have a quick look where he is. In the Netherlands, Foreign Bankers Association. Audience questions expected. Okay. So this is where you get the poking questions, which basically is where we get the information we want. So when there's press there, they tend to ask the questions that he doesn't want to say in statements, and obviously he has to answer them. So that's where we tend to get those clues as to what might be happening. So bear in mind, Powell probably knows these numbers already. There might be some indication coming out of those this afternoon. So we need to watch that at 3 o'clock, or not watch it, but watch the market's reaction at 3 o'clock. Could be something said. So just keep your eyes peeled on Financial Juice for any big spiky movements. Traders, pair bets in Fed rate cut in September. What does all this mean, look? Just nonsense, isn't it? Traders haven't done anything. Afternoon, Champagne Puppy. So, yeah, we'll have a look through the RSIs this afternoon. I'm not going to go through every pair. I went through every pair yesterday. If there's anything specifically you want to look at, let me know. There's no ADRs to look at again today, so nothing particularly exciting happening. As I say, I'm just stuck in everything sideways at the moment, not in much drawdown, not in any profit, just stuck. There you go. That's completely undone now. So we've got a couple of RSIs. The RSIs have only just got extended. So Aussie dollar yen, that's just coming up to a weekly level at the moment. That's not a weekly level. That's your 3 week ago high, which is here. Then we had that, and obviously the intervention on the Monday. So that's not really a level of any interest. It is a weekly high. But the market obviously hasn't done anything since then. So it might find some resistance there. You never know. But that's extended, or was extended, on the hourly. Not anymore. We've got the CAD yen also extended on the hourly. So that is a nice extension to the upside. But again, these are all yens. Euro yen, the same. So, there's a good chance that there is going to be some strength coming back into this yen in the form of either an intervention or some kind of buying from the Japanese, but at the moment it's not stopping, is it? So extended again. I'm not getting involved in these at the moment. There's absolutely, it's miles too late to jump in along, and it's just too risky to jump in a short. So at the moment, this is just grinding, and as far as you can see at the moment, it's going to keep grinding until we get back to that 160 level on the US dollar yen, or the equivalent on all the other pairs. They're not interested in euro yen, they're interested in the US yen. So all these yen extensions, you need to be pairing it with the US dollar yen and watching where this is, because this is the one that's going to get the reaction. Any levels that we've got previously on this, they're the ones that are going to cause some kind of movement. So those three are extended on the hourlies. They're also extended on the 4 hourlies. Excuse me. I've been doing analysis all morning. Tend to get number blind. I'll go through what I've been doing this morning in a sec. CAD yen, back up in propulsion move from the original intervention. What can you say about it? What's it going to do? No idea. That's extended on the 4 hour. But, we're just V-shape recovering that massive multi-trillion yen intervention. Completely undone. They ain't got a hope in hell, have they? Pound yen, same thing, 4 hour. Extended to the upside. New Zealand yen and US yen. It's all yen. There's literally nothing else moving. Nothing extended anywhere but yen. So you can't do anything with anything today. It's just dead. The whole market is dead. Afternoon, Aridul. Welcome aboard. Right, so I'm just going to run over what I've been doing with the position trader EA testing. So I've set another account up, which I posted the set files that I'm running yesterday on this account. So it's basically running RSI2 strategy on the daily using hourly entries. So what I wanted to do was run a full back test on every single pair using optimization. This one's just about to finish. 10 seconds. So I'm just running a system parameter permutation test on the hourly time frame entry method, which I'm running at the moment, using, there we go, it's finished, using different is that Euro New Zealand? Yeah. Using different targets and stops, basically. So I'm just testing what is the best target and what is the best stop to use out of 250 permutations of those. Unfortunately, and this is the problem I'm having with this strategy, they are all profitable. So what I'm struggling with is picking something again. So let's just see how many permutations were profitable there. 251. So that this test is 250 permutations, 252 permutations, 251 variations of the strategy are profitable. It's all profitable. So this, you probably can't see it, can you? So this is Euro New Zealand, 251 out of 252. Euro Pound, 252 out of 252. Euro Swiss, now the Swiss franc is not as good, we know that. 140 out of 250, so half the permutations are profitable. Euro CAD, all 250. Euro Odd, all 252. CAD Swiss, 250 out of 252. Aussie, 252 out. You get the gist, yeah. So Aussie New Zealand, only 177 out of 252 passed the test. Aussie Swiss was 248 and Aussie CAD was 252. So I've run this test now on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different pairs. Pretty much 100% strike rate, apart from the Swiss francs who drop a little bit. So all this test is doing is using the position trader EA to scale in. I'll show you the test. Let's do a live one. I'll use 0.75 and 0.5. So all it's doing basically is on the daily time frame, we're using RSI2. Close. Are we? Did I use close or median? I don't know. It doesn't matter anyway. But yeah, I'm using close. So using RSI2 close, basically. And when we get RSI2 close above 90 or below 10, we drop down onto hourly and wait for a bear move to start, which crosses the 9MA. Yeah, so it's the position trader EA doing what it does. And all the main difference between my normal position trading strategies and this is the scaling. And the scaling is 0.1 ADR between trades. So when we get into that initial trade, either it works and we take our profit, or it doesn't and we get in very, very close together. So the idea being behind this strategy, the RSI2, is when you get these RSI2 extensions, the market moves down very quick away from them. Yeah. So you get down day or multiple down days following. If it doesn't work after your entry and it pushes up, this RSI2 is probably still going to be extended. So as it's still extended, we'll get in again. And if it remains extended, we'll keep getting in close together. But if the market moves half an ADR against us, we'll start to scale out of the positions. Yeah. So we're getting in. If it works, it works. If it doesn't, we're going to get in. We're going to get in. We're going to get in. We'll be in a maximum of 4 positions before we start getting out of them. But the RSI2 will still be extended and embedded. When you get that move, that pays for anything you lose. That's the theory. That's the strategy. So we're also I'm using a 1.25 lot multiplier on this. Yeah. So every entry we take is a quarter larger than the previous one. But obviously, because we're stopping out, the idea is as it moves further against us, we get more aggressive. And then we need a very small amount of movement to exit the position. Yeah. So days like this, where you've got in, that move down there, which ended bullish, is enough to get you out before it ended bullish. Yeah. So we're looking literally for a candle that moves down. It doesn't even have to end as a down day. It can end as a bull day if it wants to, but if it's got a wick, we're out. Yeah. So that's the strategy. So what I'm testing is, should I get out of my single trades at a quarter of a percent profit or up to 2%? Should I get out of multiple trades a quarter to 2%? Or more? Did I test up to 2? I can't remember what the parameters were, but something like that. 2%, 0.5% to 2%, something like that. And when should I start getting out of these trades? Anything from 1 to 2. So from half an ADR to 2 ADR of movement against. Yeah. So testing all of those permutations together, there's 252 variations of all those permutations. And as you can see, it doesn't matter. If you get in over a period of 4 years and target anything up to 2 ADR of movement and get out anywhere up to 2 ADR of movement against you, you'll make money. Doesn't matter. Do what you like. Yeah, it absolutely doesn't matter what you do. So that's basically what the strategy is doing. And I'm trying to find the Achilles heel in it because I've set the account live and I suddenly thought, what if there's a better setting? Because I hadn't tested it I'd done system parameter permutation testing on it, but not in too much detail on when to get in and out. I just knew that it worked. So I started running this test this morning, and obviously found loads of profit, found loads of profit again, found loads of profit again. Ignore the moving averages. And it just started making money. Yeah, it has down periods, as all strategies do. What's this? Euro New Zealand. I don't even know which one we're testing. Yeah, so Euro New Zealand doesn't look like it responds very well to tight stops. There's a tight stop there. So this is not using a positive R ratio, so this might not actually be a good one. It will make money overall long term, but it probably won't make a lot of money. So I started testing this, and then I suddenly thought, we're getting in on the hourly time frame. Problem with this is when you get a daily extension, when you get an hourly candle close below an MA, or you get a market reversal, or however you want to get into the market, that will bring the RSI down. Yeah. So the hourly candle, quite possibly by the time it's accumulated and dropped, it may not be to the next day, in which case the RSI, as you can see on the RSI on the 2, it's very jerky. Yeah. It may not trigger an entry. Yeah. Because the RSI is so unbelievably jerky. So basically what I did was I decided to test it on lower time frames for lower time frame entries. Yeah. And this sent me down another rabbit hole this morning, which is why I was yawning earlier. So looking at the entry time frames, I started to test the hourly time frame and see what impact basically it would have on the profit of the strategy and the drawdown of the strategy. That's all I'm interested in, so I can get a risk, reward, or return on drawdown ratio. So when you're using hourly time frame, this made about 20k out of 11k drawdown, so a nice 2R return, very nice. Tested the 5-minute time frame, it made 114 grand, same period of time, same RSI extensions, just entering on M5. It made 114 grand with 22 grand of drawdown. Yeah, that's a 5R return, almost 4.5. It's massive, massive impact on profitability. The 15-minute time frame made 85 grand, but actually drew down more, weirdly enough. So that kind of tells me that lower time frames, you're going to make a hell of a lot more money, but you're going to take twice as much heat. Yeah, the original strategy had 11k a drawdown. We're doubling the drawdown basically, but you're not doubling the profitability. You're quadrupling plus the profitability. So this is kind of the high risk version of this, and that's what I'm running at the moment. And then I started testing, and this was testing with 1 ADR stop losses. Yeah, so we're giving it plenty of breathing room. I then switched down to half an ADR of stop loss. Yeah, so getting out quick. But obviously, remember, we're increasing the lot size. That produced 48k on a 15-minute time frame and 45k on a 5-minute time frame, because obviously we've got a much tighter stop loss. So if you get in on the 15-minute or the 5, if it goes against you, you're going to get stopped out on both because you've got a tighter stop. But look at the drawdown. 7k. Took 7k of drawdown to make 50k using the 15-minute time frame entry with half an ADR. Yeah. So what I'm running at the moment is all of these tests on the hourly so that I can get this data to find out what is the best return on drawdown ratio across all pairs. There must be something that runs across all of them, basically. And then pick that one and run them all on the 15 and the 5 to see what it does to profitability and what it does to drawdown. Because if someone turned around to me and said, give me 22.5 grand and I'll return you 114 in 4 years, I'll be snapping their arm off. This is one Forex pair. We've got 28 of these. Yeah. So it's, and as you can see, the reason for doing this test is to see how robust it is. 100%. 100%. Well, not 100%. That's 248 out of 252, but let's call it 100% because it's 98 point something, isn't it? Yeah. There are pairs that are anomalies. I haven't tested yens. I'm not interested in the yen because it's a trend nightmare. But interestingly, the Swiss franc holds up roughly half the time. So the Swiss franc is actually tradable as well. And I've got that in my portfolio because my portfolio analysis showed that as well. So really interesting results. This is just using the position trader EA. So as you can see here, this is not using a positive risk reward ratio, and it didn't lose anything. Yeah. So you get pairs like this where it makes a bit of money, has a bad run, makes a bit of money, has a bad run, makes a bit of money, but it doesn't lose any money. Yeah. So if you get pairs that go like that and couple it with the pairs that go like that, you're in profit. What we don't know is this pair going to be one that goes like that or one that goes like that in the next 3 to 4 years? That's why you trade a portfolio, because you've no idea what's going to move, what's going to be beneficial for what strategy. So you trade everything, and the ones that are profitable make more than the ones that lose. And this is what system parameter permutation testing is all about. So, yeah, it looks phenomenal, basically. But the interesting thing is you can quadruple the returns, but not quadruple the drawdown by dropping down to M15, because you're going to get a lot more entries, a lot closer together, which means that when those RSI2s drop, you're going to make a lot more money. But when we go into screaming trends against, it's going to take more drawdown, obviously. But because when you go into a strong move against, your lot size will be exponentially increased by the time you get up there, you make a hell of a lot more money on that return drop, which tends to pay for the majority of that loss. So if you're using uncorrelated pairs, I can't see any reason not to run. I am running it on an account now. It's only taken one trade so far. We've only got one extension at the moment on the pound Swiss, which is played out beautifully today. So yeah, so it's looking really, really, really good. So I'm going to carry on testing it and get all the results together to put into a portfolio. But there's a hell of a lot of testing to do. And because it's testing on the hourly, it's roughly half an hour a test at the moment. So it will take a while to run. But the strategy that I posted, the set file that I posted yesterday, is the one that I'm running, and that I've robustness tested across every pair with thousands of combinations. It's brilliant. But what these tests are is to find out if there is a way to make it more profitable. What I found, I did post the screenshot. But what I found basically was an incredibly profitable portfolio. But I think you can make it more profitable by taking a little bit more heat, just a little bit, not a lot. But I'll show you the portfolio, which is I split it into multiple groups as well to see what pairs work and what don't. The yens don't work, basically. The yens don't work on a lot of strategies, to be honest, over the years. When I've been thinking about it, so many strategies I've traded profitably over the years. The yens have always been very hit and miss, which is why a lot of people don't trade the yen. And it doesn't seem to work very well with mean reversion. So, however, I was saying that, I've made a lot of money with mean reversion on it, but that's kind of using manual, and I want to try and do full automation if I can with this. But so if I split the portfolio and exclude the yens, rather create a portfolio excluding the yens. There we go, 284k. So every pair bar the Euro Swiss and the US dollar Swiss and the US dollar CAD, every pair was profitable. So that's the last 4-year test. Probably can't see it very well. But every single year generated alpha ranging from 40k to 72k. And there's the odd losing month in there. You can see there's multiple losing months. 1, 2, 3, 4. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. There's 12 losing months. But that's the equity curve. Yeah, so you got blips every now and again and stagnation there for approximately 3 months where it stagnated. So yeah, can't really fault it. Average pair volume gets up to sort of like 4 lots max as well. So it's not actually getting into too much heat. If you look at the drawdown, the maximum portfolio drawdown overall is 20k there. But by then it had already made 100k. So it doesn't matter. The only downside is if you took that, if you started trading there, you're immediately going to drop into 20k drawdown. So you've got to have the balls to hold it to get it back. And this is only using 1% risk as well. This is what I would class as a fairly conservative approach. So it could be a lot bigger than that. But yeah, looking good. So I'm going to run some more tests on it. But this can all be done with the Position Trader EA. You don't need anything else. It does it all, which is the set file I've posted. So you can go and play around with those set files if you want to. I have run a back test from 2015. It was losing money, quit a lot, RSI 2. Hello? Mine's not. Don't know what to say, Peter. You only add if a trade goes against you. Yeah. On this, on the Position Trader EA, yeah, because you can't add to winners. Afternoon, Brian, Fletch, Chucks. Are you testing the RSI close or the median? That's the close. It won't make a lot of difference whether you choose the median or the close. Really doesn't make a lot of difference. Yeah, I mean, I mean, if you look at the difference between a median and a close, you're just going to get different entries. But at the end of the day, we're looking for the RSI is a measure of relative strength. How you measure it, it's gone up. Yeah, what we're doing is we're playing off the back of the bank's profit take moves. Yeah, so it's the same as any mean reversion strategy. Mean reversion strategies benefit from bank profit takes. So however you get in doesn't matter whether you use a median RSI, whether you use a Bollinger Band, whatever you use for a mean reversion measurement. Use either or. I haven't tested it on the median, but the only reason I use the median on my normal RSI is because this mimics the TDI, the Traders Dynamic Index signal line. Yeah. Which is how I started trading RSI, because I started trading TDI. And this, I wanted to extract the closest I could get to the TDI, because basically I started building this strategy by watching what was happening with the TDI while I was trading stop loss strategies with it, and discovered that this part of it, which is not the part that they concentrate on at all, this part of it was the bit that was actually useful. And then I figured out it's just an RSI, and it was happened to be a median RSI rather than a close. That's the only reason I use it. But if you use a close, it will make very little difference. It will make a difference, but you will still be getting in when the market's pushed. Yeah. The median is wrong measurement to use sometimes. The close is the best one to use. Sometimes it's the smooth. Sometimes it's something else. Sometimes it's the open. Yeah. There's always going to be a setting at some point which is better than another setting. Yeah. You may have the one on that day that got you in spot on, but on that day, it was the wrong one. Yeah, it might have been the smoothed that was the best one to use. It's never going to be the right one to use all the time. Test them. You'll see. You could use whichever. I think if you emphasize on less drawdown, yeah, if you want to. Depends how risk averse you are. I'm using 1% risk. You can halve that risk. You'll halve your profit. You'll halve your drawdown. Yeah, you can use a lower stop loss, and you will take less risk. It's very, very, very clear in the results. Look, yeah. So if I sort this by drawdown, the largest drawdown uses drawdown start triggers at 175 and 2. Yeah, they're all 175 and 2. Odd 1.5 in there, yeah? So, and the drawdown is 40k in this particular case. Which one is this? Euro New Zealand. Yeah, New Zealand pairs aren't actually that amazing. But yeah, so it generated 20k in that case. It generated 42k there, made 32 drawdown. Yeah. So, but if you look at it, we're starting drawdown at 2 ADR, but we're taking profit at 0.75 ADR. You've got a negative risk reward ratio. Of course, it's not going to be very good. Yeah. You're taking twice as much loss as you're making. And if you get into multiple positions, you're still taking less than you're making, right? So flick that into lowest drawdown first. All of a sudden, you see the drawdown trigger starts at 0.5, which is why I say tighter stops are going to give you less drawdown. It's still making 8 grand, 10 grand, 5 grand, 9 grand, 18 grand. Yeah. So there's some seriously good return on drawdown ratios here. 1.8, 1.8, 1.8, 2. Yeah. Using this. But look at the risk reward. We're risking half an ADR. We're making 1.75, 1, 2, 0.75. Even that is a 1.25R. The very lowest is a 1.25R. If we get into 2 positions, we're going 2R. Yeah. So, of course, it's going to take less drawdown because if the market goes into a big, strong trend, you're going to take a lot less heat. But when you get a down day, you're going to make twice as much as you've lost on that heat. So if you get into 4 positions and then it moves up and you have to take that and take that as a loss, that is going to pay for that and give you a break even. Within days, this is all happening as well. It's lovely because it's an intraday strategy. You're in and out, literally within a day or two. But yeah, if you want a low drawdown, do that. But the best thing to sort by is return on drawdown. Yeah. Forget drawdown is going to happen. Yeah. You can't stop drawdown. But what gives me the best return for my risk? What is the best return on drawdown I can achieve? Yeah. And it's, funnily enough, somewhere in the middle. Always is. Yeah. So half an ADR is going to have less drawdown, but you're going to get stopped out a lot because the market moves within ADR 58% of the time. We know that. So 58% of the time, you're going to get stopped out. If you put your stop outside of ADR, all of a sudden, your chances of getting stopped out are less than 50%. You're going to hold more trades longer, which means you're going to make more money. And if you target a decent move, like a 0.75 to a 2, you're going to make 62 grand for your 28K instead of 28K for your 28K. Yeah. This is what system parameter permutation testing is all about. It's not about finding the holy grail. It's about testing to see what impact stuff has. Is it better for me personally wanting what I want to have a tighter stop or a wider stop? Is it better for me personally having what I want to have a bigger target or a smaller target? If you're the type of person that wants to get in and out within 24 hours, you need a smaller target. Yeah? If you're the type of person that wants to make an absolute shed ton of cash and is really happy to walk into a casino, yeah, that's what you want. Return on drawdown. You're going to take a lot of heat. Your portfolio is going to go into that. But if you're not going to look at it and you're not going to panic about it and you're happy to ride the waves, you're going to make more money. That's how trading works. The problem is human beings, when they see money, take it. Human beings, when they see things going wrong, stop, system hop, and go somewhere else. This shows you that if you don't system hop, you will generate revenue. That's what I do. Yeah. I've traded this strategy for 5 years and I've taken a lot of heat. I've made a lot of money, but it's because I don't do anything else but this. So you can fine tune it to what you want. And ideally you want to pick something in the middle. Yeah. So if you sort it by return on drawdown and exclude the top 10, yeah, start from somewhere in the middle, where's roughly a good area to be that's going to generate a little bit more than I'm going to go into drawdown by, that's where you're going to make your money, because there's a lot more chance of this happening again in the future. But it's the same on all pairs. Yeah, return on drawdown. If you sort it by return on drawdown, look at that. 14K drawdown, 89K return. Yeah, somewhere in the middle, 0.75 to 1 ADR. But target is 1 ADR to 1.75. So when it hits down, if it continues to go down, you get out quick. If it doesn't, you hold it, or rather it holds it. But the other interesting part of this, the other EA that I've built to back test this strategy, also has an end of day exit. Now, the end of day exit in profit is also very, very profitable. So basically, if it goes into drawdown and it comes back into profit, you shut it. Simple as that. So you're not necessarily going to hit that. But also, you're not going to get caught out when the market does that. You'd have stopped out on that, but you took the profit at the end of the day because it was there. It's another way of exiting. Again, none of they all work. This is what I mean. They all work. I can see why Larry Connors was using this strategy for such a long time, and people are still using it today because it just bloody works. It's really good, but it only works on the daily time frame. You drop down to H4 or any lower than that, gone, fails. Daily only, and that's the whole point of it. We're looking for multiple days that are strong in a row. Yeah. Other people have adapted this strategy to the 3 down day strategy, which is a well-known strategy as well. That will work in a very similar way. What I've done is adapted it to not a stop loss strategy, but a scale in position trading variation. That's the difference. Like I said, that's what the Position Trader EA is all about. Pick any strategy under the sun, remove the stop losses, and turn it into a position trading strategy, and all of a sudden it becomes more profitable. Because you're not just taking a loss because the market's moved. You're taking a loss. In this case, we are taking a loss because the market's moved. And again, I haven't tried scaling out with partials either. There's another option. There's a million options, basically. But at the end of the day, RSI is amazing for measuring mean reversion. We know that. That's why we use it. But this super fast one, it's not something I've had to look at before. So, but anyway, we'll see what happens. Imagine all the data Jim Simon's Renaissance Technologies has with different quant systems. I have no idea what you're talking about. Never heard of him. Don't know who that is, but anyway. Afternoon, Blue Trader. Still cloudy. Oh dear. Why have you chosen to use a stop loss with this strategy? Because it's a scalping strategy, basically. So you can't scalp without a stop loss. It's suicide. Imagine taking a scalp, your first entry scalp long there. You're dead. Dead. Doesn't matter how many times you scale in, you're not getting out of that. Yeah. But with my strategy, you get in here and you get out there. With the RSI2 strategy, right, so there you go. Look, that's my entry there. With my normal position trading strategy, yeah? If you use an RSI2, you got in here. Ouch. Yeah. But you got in there and got in there and got in there, there's a possibility you would have got out on that spike intraday. It's an intraday scalping strategy. However, there you would have probably lost money. This is the Swiss franc pair, though. This is the thing. The Swiss franc is not good to trade because it has safe haven runs which are long and protracted. This is a safe haven run of some description. The Swiss franc going nuts. Yeah, this is why the Swiss is not the best thing to trade. However, in my testing, if you look at the Swiss franc, won't include FJ, Zealand and US. So this is the Swiss franc portfolio. See this, look? There's a lot more of that in the Swiss franc because this is the Swissy getting pumped. Yeah. Interest rate change. Where was it? 2023. Where are we? 2024. So it's 2022. Probably there. March 22. Yeah, that's probably about it. Where the Swiss franc suddenly went, guys, we're changing our interest rates. Sorry, we didn't tell you. Yeah, that thing went nuts. You can't get out of it. It doesn't matter what you do. And don't forget, this is simulating a lot multiplier as well. If you don't use a lot multiplier, your drawdown is going to drop dramatically as well. Yeah, go and do the testing yourself on this because there's so many variations that you can use. But you will find intraday it's very, very good. Just don't try and go for massive runs. Yeah, it's a short scalpy strategy. US dollars on the move. There we go. Massive positive news for the US dollar. Massive negative movement. Yeah, news. Never does what you said. Somebody may have just said something. Let's have a look. So this is just the market reacting to the US dollar, gone completely the opposite direction. So watch this, a double bottom bounce down here. Yeah, I'd be more than happy to see that back up there this afternoon. Yeah, they're probably going to put a V-shaped recovery on this. There's no reason for this US dollar to dramatically drop on a massive PMI push unless that has come out somewhere and we know that that number is dropped. If that number's dropped, obviously it's going to be a different story. Let me just set that running. Right. Yen pairs less compatible with most strategies in the long run. Yeah, because the yen goes into massive runs. Basically, it's weak. Yeah, the yen does that. It's a trending. If you take that out, move it back to normal price action. Yeah, it goes into that's COVID, obviously, but it goes into strong runs like this, and also the volatility intraday changes a lot. So you'll get big, strong intraday moves like this. So any strategy will get hurt a lot because any strategy that uses a stop loss will get swept all the time. You need big, wide ADRs, big, wide stops on the yen. And because you need big, wide stops, you need much further targets. So if you get into something like that, you're going to need to put a stop loss under there, which means you're going to need to get somewhere like that to get out of it, which is going to take you 3 months. Really, really hard to trade. Look at it. I mean, this is not normal price action. You do not see this type of movement on most instruments. Because the yen is also a safe haven currency, we dump into the yen when there's problems. But the economy in the yen is never, ever used interest rates. So there's no reason to keep your money in there for any long period of time. The longer your money is in the Japanese yen, the less you make. Yeah. But if there's any kind of problem anywhere, you want it somewhere stable. Yeah. Low interest rates, less fluctuations. It's a safe haven. Same as the Swiss franc. So it's a very volatile instrument. All the yens are the same. They always have been. But a lot of people love this. A lot of intraday traders love it because it's, it's highly volatile intraday, but highly unpredictable. But intraday, you can make some good money out of it. I just have never scalped it, never tried to. So I just don't. It's just not my my way of trading, basically. But yeah, so if you look at all mean reversion strategies, they don't work as well on the yen. Trend strategies do, if you can get in on the trend. The problem with trend strategies is you need a confirmation, usually like that, to identify a trend. You've usually missed quite a lot of that move. With the yen, however, it will go off for ages. But you've got to hold it for a long time. And as Dougal's just said, the swap is ridiculous if you short it. So you've got to go long. Because the short swap is untradeable. That will get better, though, as interest rates increase. So it might... This is what I'm saying about this yen. This is why I'm kind of sitting on the sidelines a little bit at the moment with it, because this is changing. They've moved for the first time in a couple of decades into positive interest rate territory. They have the power to do this, which will be taken away when they move more into positive interest rate territory. So it will possibly become a much more stable currency to trade. I've never had any problem making money out of it. Because it's volatile and it moves up and down a lot, I've never had a massive problem with it. It squeezed me like other stuff has. But this recent move has been awful. Just, blindsidingly awful, the way that it's moved. Just because it's in trouble. They're in trouble. They're in what's called a death spiral. By continuously propping up their own currency with overseas investment, every time they need to pump their currency, they need to liquidate the thing that makes them money to make them poorer. You liquidate, it's like chucking your money down the drain. Every time you get into a problem, instead of making money, you have to throw it away. Imagine doing that. You're going to run out at some point. And this is the problem. This is why I'm looking at this going, is this the last possible chance? What happens next? Countries do go bankrupt, yeah? The US nearly did it a couple of years ago, didn't they? Yeah, they nearly defaulted on their debts, bankrupt. It happens. The Brazilian real went to a point now where if you want to go to the shops and buy a pint of milk, you need to take 2 rucksacks full of notes just to buy a pint of milk because the currency is that devalued against everything, yeah? It happens. To happen to the US would be very unlikely, but to a company like Japan, who make most of their money out of technology exports, with China now becoming the dominant force in technology, where's their economy? They're a tiny little island in the middle of the Pacific. Yeah? They have nothing else. If we do not buy stuff from them because China can produce it cheaper, in the same way as they've done to the UK with the steel industry. We used to be a big steel exporter in the UK. We're shutting all our steel plants down because we can buy it and import it from just China cheaper than we can make it in the UK. How mad is that? But it happens. Yeah. Is this what's happening here? We don't know. Either way, you do not want to be really long-term on this. Short-term, fine. Do what you like with it, as long as you're getting in and getting out on a regular basis. But if you're going to go, I reckon this thing's going to drop for the next 6 months, I don't think you can see that far ahead anymore with the yen. I think it's got some fundamental problem. As you can see here, this intervention has not worked, has it? Very clear. So, as Dougal's just said, short at 160. Yeah, but we said short at 145. We said short at 150. We said short at 155. Short at 160. Yeah, that's $20. What's next? 170? 180? Where does it stop? We're all guessing. Everyone's guessing. All the analysts said 145. 145 was back here. 145 is not even on my chart anymore. It's that old. This is a 4-hour chart as well. Shows you how long I've been watching this thing, looking at 145. That was the original intervention level, 145, which is here. Everyone went 150? Definitely. What? What do you mean not? 155? That was 150. 155? 160? It just goes on and on and on and on. So who knows? We do not know what's happening with it. Nobody knows. But you stick an RSI2 on this, after a couple of up days, does have down days, but it's still not very profitable at all. It's bonkers. Exactly. So do you think the position trade EA designed for large capital? It's for whatever you want. No, nothing's designed for any size of capital. EAs are designed to automate trading strategies. A trading strategy uses risk. Risk is based on your account size. So if you've got $100 or $100,000, use different lot size. The strategy does not change. Capital is relevant. If I've got $100 million, I'm going to make more than you. I'm not going to change my strategy in any way, shape, or form. I'm still going to risk 1% over an ADR distance. It's just that I'm risking 150 lots, whereas you're risking 0.1. Capital has got nothing to do with profitability at all. It's to do with the amount of money you can make, but the profitability percentage return, the percentage return, this is why you use ADR and you use percentage return. If I've made 7.88% this month, that's 7.88% of my account size. You would also have made 7.88% of your account size with the strategy. Nothing is different. The strategy is the same. The risk is the same. The percentage return is the same. The amount of money is based on the capital. But that doesn't have anything to do with any strategy or EA or anything. All the same. Afternoon, Steve. Why do you give all this information and access to your EAs free? Today. Yeah, maybe I shouldn't. That's the end of it. Sorry, turning off now. I don't know. Because that's what I do. It's a very lonely profession, this. I sit in this little office on my own all day, every day, and I have for 15 years. It's quite nice to talk to people. As you're probably, this is why you're here, because you're probably doing the same thing. It's just, you don't have work colleagues in this industry. You have lots of people on groups that you can talk to, but groups are the worst thing to be in, which is why I said about Forex Factory the other day. If you go onto Forex Factory, and you go, right, I'm going to join some of these trading strategy forums, okay, where do I start? Which of the 3,200 strategies shall I go and talk to people in? If you pick more than one of them, you are permanently system hopping between two strategies. If you leave one of them and go into another thread, you've hopped to another. This is why some of these idiot trolls I've had recently, they have been on this thing for 10 years and they're still on it, hopping, because you'll never get out. It's a dangerous place to be. But, it keeps me accountable as well for what I do. So if I'm in here every day doing the same thing over and over again, hopefully people will see that this is how you do it rather than hopping off to different strategies. I make a fee out of my indicators and EAs as well, but that basically pays for my time, which I spend 90% of my time doing support for the EAs and indicators. But what else can I do? I'm sitting here, right, waiting for this thing to light up to there so that I can get into a trade. I'm not, because it's a yen, I'm not going to get into it. But you're literally sitting here waiting for things to happen. Nothing's happening. So I can't trade anything because nothing's happening. So you do other stuff. What I've been doing all morning is not trading because there's been no setups. So what I've been doing all morning is analysis and testing a strategy. Because there's nothing else to do, is there? You sit here all day long and you just watch the charts go up and down, which, when you're looking at stuff like this, I've been looking at this for over a month. Well, not over a month, for a week and a half now, doing that. Boring. Have something to do. Otherwise you go mad. You literally will go mad. I've taken up baking. There you go. There's nothing else to do. My question is, if in backtesting one pair you show a DD of, let's say, 20%, wouldn't you think running multiple pairs would at some point possibly cause you to hit a margin call? Well, that's why you do a portfolio test. Yeah. So this is what the portfolio test shows you. This is a portfolio of 21 pairs. I think there's 21 in there. The maximum drawdown at any point was 20K on all of the pairs combined. So this line here, each of these lines here is a system, a strategy. Yeah? If I change this to sub-assets, sub-equities, yeah? So this is each individual pair and how each individual pair performed. You'll see some of these made a loss, but the vast majority made a profit. Yeah. So you smooth that out into a portfolio, and that gives you what would have happened on all of the pairs combined together. So they all got hurt there. They all got hurt there and there and there en masse. Something happened to cause drawdown. The very worst case scenario is it went from around about 100K to 80K. Yeah, $20,000 of drawdown. So if day one you had started there, you'd have taken 20K of hit. But this is the past. I have no idea what's going to happen in the future. But this is all you can do is look at the past, because we can't test the future. So, and this is what robustness testing does. If I test 252 variations of it, saying, shall I get out at here, 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 or here? Or shall I get out at here, 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 or here, or here? If I've got one trade, or if I've got more than one trade, shall I get out at here, 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 or here? Test every single possible combination of all of them, meaning that if you'd have woken up in the morning and you'd pressed the button because RSI 2, and then in the afternoon you'd have gone close at random, you'd have made money every single time, because it doesn't matter. But even with a negative risk reward ratio, you still make money, because the strategy has a high strike rate. The strike rate of the strategy is 63%. You've probably heard me say it in here in the past. It is incredibly rare to find a strategy with higher than 50% strike rate. Everybody is striving to find something that has a higher than 50% strike rate, because that means you could basically use a 1-to-1 risk reward ratio and still make money. There are on something that moves at random, it's incredibly hard to find an edge, because there is a bull candle or a bear candle. The market goes up, the market goes down. The coin is heads, the coin is tails. It's a 1 or it's a 0. It's binary. By default, if you run 100 tests, 50 of them will be one of them and 50 of them will be the other, because it only goes up and down. This is what people fail to see about the markets. It's binary. Yeah. The only way you can put the odds in your favor is to find an edge that has repeated itself X number of times in the past. Support, resistance, market reversals. Yeah. Oscillators. You've got to find an edge that puts that 50 slightly higher, or every time it happens, it's less than 50, but the reward is more than X. Risk reward has got to be positive. So to find something where you have a positive risk reward ratio and a strike rate above 50% is like rocking horse poo. Chocolate fire guard doesn't exist. Yeah. Very, very rare. There's hardly any strategies out there. The Turtles found one. Larry Connors found one. There's a few others. Larry Williams has found one. There's a few other people out there that found them. But they're not, they don't exist much. This is why everyone system hops. Because even if I gave you this right now, and you can do this right now with a position trader EA, yeah, As soon as you start trading with it, if for 3 weeks it goes into drawdown, you will stop trading it and you will go somewhere else. There's nothing wrong with this strategy at all. There's nothing wrong with the position trading strategy I've been trading in here for 3 years live on YouTube. It works. But if someone goes into drawdown and they don't make money in 2, 3, 4, 5, 6 weeks, they're off. That's the problem. This is what this testing does. It shows you that you can make money with anything if you give it a chance to work. Yeah, it's going to lose money. It's going to stagnate. This stagnates for 185 days, I think it is. 153 days. For 153 days, 4.5 months, this didn't make any money. Can you imagine starting today to trade this and 4.5 months later having no profit? What would you do? Gone, aren't you? You found another strategy. You found it way before that. You probably found it there. You moved there. That's all you gave it. Yeah. But you missed it all. You missed all of that. Run there. And interestingly enough, if you look at the drawdown, this is the S&P 500. That's the stagnation. Yeah. This is the S&P 500. Stagnation. S&P 500. Now, this didn't stagnate, but it did take a large loss during the bear volatile market. So this year, it didn't make an awful lot of profit. So it seems to me in a bear volatile market, it's not a great strategy. What happens in a bear volatile market? Yeah. ADRs contract on Forex and expand in stocks. It's high risk, high volatility, risk on scenario. So if you see the market going bear volatile, you could stop trading this. But then what do you do? There is no strategy that fits everything. It just doesn't exist. Everything has drawdown. It's controlling it and knowing it's going to happen. Yeah. So if you traded this portfolio, right, with the full knowledge that 22 grand of your money is going to vanish, in this case on a 50k account, roughly 50% of your money is going to vanish, you wouldn't have a problem. If you get into this expecting to buy a Lamborghini in 2 months' time and expecting this to generate 5 to 10% profit a month every single month, you're not going to carry on with it, are you? And it clearly shows that there are losing months. 900, 4,000, 8,000, 3,000, 3,000, 5,000, 3,000. It loses 5 grand a month sometimes, but it also makes 20, 13, 6, 16, 12, 19. The months it works, the months the market conditions are right for mean reversion, it makes a killing. But it's not going to do it every month. It had 2 months in a row it lost money in 2022. What happened in February 2022? Bear volatile S&P. February 2022. We entered a bear volatile market for the first time ever. We never had a bear volatile market like that in history. The strategy didn't make a lot of money. What did it do? Make some money. Yeah. Everyone else was dying. But this is the advantage of portfolio approaches, because some instruments, US dollar, Swiss, etc., will have been probably killed there. Aussie, New Zealand, pound, euro, not a problem. Didn't affect us. It's the S&P 500 and all the stocks in the US go nuts and go into a massive bear volatile collapse. Who gives the monkeys in the UK? We don't. So the UK pairs will have done very, very well. The US pairs will have done badly. And I know for a fact the Swiss franc really got hurt there, which I just showed you, didn't I? Swiss franc, boom. Not just a hit, a collapse. It really got hurt. And the Swiss franc's been hurt a lot, but that's what it does. Safe havens. I'm pretty sure you'll find that's not it. That's it. That will be probably the, actually, no. When did the Russian war kick off? One of those will be the Russian invasion of Ukraine, because the Swiss franc went nuts. You won't get a mean reversion on something that's going parabolic. Same as oil. You could also include in this type of approach, you can include all the commodities. Somebody contacted me and said, have I tested it on the S&P 500? Because this strategy was originally designed for the S&P 500 as a long only strategy, and it works bloody well in a bull market. In a bear market, doesn't work at all. So you use a 200 moving average filter and you go long only. Fantastic. So you could incorporate that into it, which is going to smooth out your equity curve even further. You suddenly stick the S&P 500 in here and a couple of commodities like oil and gold, you'll probably find that smooths even further because they will move independently from FX pairs. When FX pairs are contracting, you'll probably find that the commodities are expanding because commodities are linked to stocks. You could even chuck a couple of stock pairs in there if you wanted to. Pairs, instruments. There's all sorts of variations you can do. But portfolio approach is that is what we do. Yeah. When something is working, something else isn't working. We wait for the thing that isn't working and we take the money on the thing that is working. We just continuously bank money using a portfolio approach. But that's intraday. And the reason I'm looking for intraday at the moment is because of this ridiculous situation that we find ourselves in at the moment. And as the US dollar does not move its interest rate, I can't see us getting out of it this year, to be honest. We're just going to be stagnant. It's going to be horrible. But that's the way it is. 160 is the only short position I have on the US dollar yen. If I can't see it getting there, I really can't. That's such a long way. It's weeks and weeks. You'd need it to grind like this for the next 3 or 4 weeks, which would probably fall in line roughly with when the next US dollar interest rate decision is. That might be interesting. We'll see. I don't know if you discussed this in the chat or last videos. Is it possible with the position trader EA to handle a trade with a grid? No. Grid trading is, again, suicide. Think about what you're doing with grid trading, yeah? You are saying, I want to get in short here. If price goes up, I want to get in short again and again and again and again and again and again and again. What if there's a news event that sends price like that? Why would you take trades when the market is going parabolic on a fundamental news event? It's the stupidest thing in the world. Grid trading does not work. You might as well use better off actually using martingale. But wait for the market to come on side. Yeah, the whole reason I trade the way that I trade is because I want the people who I want to trade with. Oh, look at that volatility that's just coming on the US dollar yen. It's just gone a bit mad. And pick a pair. So the whole point of the market reverse alert EA or indicator is to show you when there are buyers on side or the moving average cross. Yeah. So if you get into long and price pushes down against you and it does that, why would you bother getting in long again? Yeah. When it does that, get in because there's buyers on board. Yeah. The only way this thing's going up is if the people you want to make it go up are making it go up, the buyers. Yeah. If you're long, you need banks and institutions to be long with you. If not, it's not going up. Yeah. So if you just get a grid and just get in because price moved down, you're just adding to your drawdown, exposure, lot size, stress, pressure, because price is doing what? One of two things it can do. Yeah. Don't get in just because it's going down. You get in because it's gone down and it looks like there's people coming back on board that might help you go in the direction you want to go in. That's why Market Reverse Alerts EA uses Market Reverse Alerts EA, uses Market Reverse Alerts to enter, and the Position Trader EA uses a moving average cross to enter. Because if it's crossed up above the moving average, it means there's buyers on board. If it's crossed down below, it means there's sellers on board. If you want to go short, you wait for the sellers to come on board. If you get in just because the buyers are on, you don't know when the buyers are going to stop. They might do that for the next 3 days. What's the point in continuously hitting that button and going into drawdown for 3 days unnecessarily? There's no. This is all the grid EAs you'll find out there work fantastically. There's also grid recovery systems which try to use grids to get you out of problems. Do not use those. it's just going to add to your problems. Yeah. Wait for price action. Yeah. This is why the position trader EA is looking for levels. I haven't got a trade on there. I haven't got a trade on there. I've got a trade on there. So next long is here. Yeah. I'm not going to get in just because price has got there. What I'm saying is I got in here, wherever it was. It's moved down by 3/4 of an ADR against my position. I'm not going to get in just because it's moved down 3/4 of an ADR against my position. That's because the sellers are pushing it down. When it gets below that level and the buyers start to push it back up, then I will get into a new position as long as it's below that level, because I don't want to get in too close to that one. Otherwise, I've got the possibility of, in this case, just going long, 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 long. You're just building a load of position. Then a news event comes and you're bankrupt. You see all these people on all these groups, yeah, showing you a beautiful trade. What you'll see is 100 lines like this. And then they'll show you their P&L. $6,500 on this $600 account they started with. It's because they've just basically gone gamble, 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 gamble. Because they're just pressing the button, hoping one of a 50-50 scenario will work in their favor. They never show you the ones where it goes against them. In the same way as a grid trading strategy will never show you an example of it going parabolic against the grid 20 positions before blowing the account. All the time. All the time happens. That's where position trading is different. We're not getting into a position because of any other reason than someone is coming behind us to hopefully push us in the right direction after the market has done something parabolic. Yeah, this is why we use relative strength or ADR to try to time our entries, because we know that if the market is pushed down like that, the banks will want to take profit on the move. We don't know how far that will be. It could be 3 days, it could be 5 days, it could be 7 days, it could be this afternoon it goes the other way. We haven't got a clue. So you've got to space your entries or use a stop loss. And that's where the RSI2 strategy with a position trader EA, that's what that does. It doesn't use a stop loss. It just says if it's gone X against me, shut it. It's basically a stop loss. It's just a hidden stop. It's not physically in the market. But we're not going to get in just because. We're going to get in when the market moves in our direction. Yeah. Morning, xrupdate.news. Market's open. Beautiful. I just posted this in Telegram earlier and Discord. What a month so far for the stock index hedge strategy. Market has certainly come back to life. These breaks are really nice and clean and have been all month. It's been killing it. So I've got a very, very small account running at the moment. But the DAX today was beautiful. So the DAX was a nice clean break. Clean break down. I'm only using 1R and 3R targets because it's still not got momentum, but the breaks are now happening at the open again, which is what the strategy is all about. If I hadn't used a trading stop on that, I would have taken that today, but I didn't. Yeah, so it's all starting to come back to life. Beautiful break on the FTSE this morning. Nice clean momentum up, out. So yeah, very good. Seems like it's coming back to life. We had that stagnant period of just wasn't moving anywhere. So long NASDAQ today. That's already hit TP. There's your break. Nice clean break again. TP trailing second half. Long on the Dow. No trades on the S&P because I've already banked on that today. I forgot I shut my platform down yesterday and I had a short on, which was the second half of yesterday's trade, which I forgot to close out. So that's already banked today, but you would have broken along on that by the looks of things. And in fact, you might even be hedged on that. No, you wouldn't. You'd be long only. So all broken long today, but not a lot of movement in the Dow. But again, this is what I keep saying about this strategy as well. Any volatile movement before the open tends to exhaust the market, so you don't get those clean breaks as much. It's harder to move, isn't it? Yeah, as Roswitha just said, I give all the information for free, but you can still buy the EAs and indicators. But also, you, as I say in the bootcamp, you don't need indicators and EAs to trade. Yeah, you can do everything that I do using any indicator under the sun. Position trading is a methodology. It's not a strategy using specifics. I give you all the specifics that I use because that's what I have found to be the best. However, that's me. I use RSI and market reversal alerts. You could use Bollinger Band and a simple bear close. Yeah, I built the products for me and I put them out there for people to use, and I charge for them because I have to support them. But you don't have to use anything. Like I said, everything's 50-50. If you flip a coin every morning and go long or short based on heads or tails and turn that into a position, it will work at some point, as long as you don't scale in too much. I've scaled into a few shorts on the ends. If it breaks all-time high, I'm out. You will be. I've been watching this. I think I said last week. I was watching this as we were pulling into this retracement here. I was looking for some bearish price action. We haven't had anything yet. If you look at it on the daily, I don't think we've had a bear day yet. Yeah, we had a spinning top. So, yeah, after the intervention, the second intervention, it's basically been bull, 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 spinning top, bull, bull. This is probably the most bearish candle we've had at the moment today. But I haven't found a reason to get in. A break of that low would have been a good entry. Still haven't had it. It's bullish. But I don't know what it is, to be honest. Certainly not bullish, is it? After being intervened against twice. I think this is probably the Japanese allowing the market to make its money back it lost, because it lost. So I think, from what we heard, the Bank of Japan were liaising with the US. So the US knew this was coming, because obviously the US had to agree to devalue the dollar. But it was done in a controlled way so that it really didn't devalue the dollar apart from anything against the yen. So I think this is potentially them giving the market breathing time, which is probably what happened last time. If you think about it, we had a 2-week accumulation after the intervention before they pushed the next leg. That might be what's happening. Who knows? Nobody knows what's happening, do they? If we knew that, we'd know what to do. What do you make of the US dollar? News came out positive, but it's tanking. Yeah, it does whatever it wants. The news has got nothing to do with the direction. The news is a catalyst to put liquidity into the market so the banks can move it in the way they need to move it to make money. Yeah, so that initial move up on the US dollar CAD is undone. I suspect we'll get down to the lows here. We'll find limit orders trigger and fire it back up into the mean, because tomorrow is CPI. So the market's not going to drive this anywhere today, because they don't know what's happening tomorrow, unless they do. Unlikely, but this could be a precursor move, them getting ready for what they think is going to happen tomorrow. If it doesn't, obviously we'll find a massive move in the other direction. But I personally think the CPI is probably going to bounce again tomorrow, in which case we will be back up here, because it'll be massively bullish. But I mean, look at it. Look at the US dollar Swiss. Yes, it's a wick up. Yes, it's a candle down. But has it gone anywhere, really? It's not going anywhere, is it? It's had an intraday move, which has hit ADR, which it does 42% of the time. So all this is pretty much a 60-40 shot happening, which we had there as well. But look at, we're not really moving at the moment, not until that CPI number comes out. When the CPI number comes out, that's what we're going to get. tomorrow. That or that. Today is just orders. Can you run the position trade EA in a fixed lot size or keep the limited percent of risk without a lot multiplier? Yeah. Go and have a look. If you're not familiar with the EA, go and have a look at it on the website. There's a link. There's a detailed video. There's a massive manual. Everything you need to know is all on the page, or linked from the page, I should say. What do you make of the US dollar news? Oh, you just answered that one. Understood. Where exactly did you post the set file template? Discord or Telegram? Both. Afternoon, Youssef. It's me. Hello. What do you mean it's me? Were you answering a question to something I said earlier? Was it you that contacted me in Telegram about the S&P 500? Yeah, if that was you. Start of 2022, the big dip. Yeah, Russia, Ukraine. Yeah, it was 2020. You can look at the US dollar Swiss; it will tell you. Actually, look at oil. The best way to know when the Ukraine war kicked off is to look at oil. It was January. It was March 2022 to April. Yeah. Yeah. That's what happens to oil when the war kicks off. Always, always, always. What does the entire population of the planet need to fuel its boats, its tanks, and its jets, and its rockets? Petrol. What's oil made of? What's petrol made of? Oil. What happens to the demand for oil? It goes up. Therefore, what do they do with the prices? Throw it through the roof. So that's the Ukraine war kicked off February 22, which is where we started going into the bear market in the S&P. All happens. Everything happens. Everything is interlinked in trading. Everything has a confluence with everything else. There's always a knock-on effect. There's a finite amount of money available for banks and institutions to trade with. Yeah. So if you suddenly need to buy the crap out of oil, you've got to liquidate assets somewhere else, currencies, commodities. Something's got to give, bonds. You've just got to sell stuff to make pots of money so that you can pump it into something else. Yeah. So if you're going to pump the crap out of oil because oil is going to go through the roof, you sell all your stocks. Stock market collapses, oil goes through the roof. US dollar drops. Yeah. There's an earthquake somewhere. Shit, our money's not safe anywhere. Liquidate the whole lot and put it in the Swiss franc because the Swiss never get involved in anything. Their banking is stable and their interest rates are really good. Yeah. Everything else gets liquidated. The Swiss franc goes through the roof. Conflict. Worldwide events that cause things, earthquakes. Tsunami. Look at the tsunami. Go and have a look at what happened to the Swiss franc during the tsunami. I was there. Grids will blow your account if you stick with it. Yeah. Same as martingale. Grids and martingale are the two things that will at some point kill you. But on the way to killing you, they will make you a lot of money. But the problem is, and this is the problem with martingale. Yeah, I've built martingale EAs and I've tested them over years and years and they've gone like that. And I've gone, holy crap. And then it goes like that. And you're like, yeah. And you won't get that size on either because your broker won't allow the lot size that you get to before that happens. But anyway, but for prop, if you got in there and use martingale, you'll pass an evaluation. Very highly likely. You will also pass stage 2 and get to funded, which is why they don't allow martingale strategies in prop. Because they know for a period of time, go and look at the RSI2 strategy, right? You can test this. If you go into the position trader EA and change your lot multiplier to 2, You probably want to do the spacing a little bit different, but change the lot multiplier to 2. Have a spacing which is lower than your exit. Yeah, meaning that you will get a second trade on before that first one gets blown. Yeah, and set your target to be twice your risk. You watch that equity curve before it hits a massive trend. Yeah, but Martingale is absolutely fantastic at making short-term gains. If you want to double an account, if you can't afford to trade and you want to double or treble or quadruple or 10x an account, Martingale will do it. If you're lucky enough to hit a run where the strategy that you're using has a decent run of luck. When you get into a strategy and you use Martingale and you start there, you're dead. Yeah. If you start here, you're fine. Assuming it's a mean reversion strategy. If it's a trend strategy, it doesn't matter, does it? But yeah, it's brilliant at doubling accounts, but it is gambling. It's a gambling strategy. It's originated from casinos. So, you know, you are gambling, and gambling there, the house has a definite edge. You ain't gonna win. Holding Aussie New Zealand until it gives me an A-shape recovery. This Aussie New Zealand, I still think I'm not in it anymore, but I still think we're on for a pullback on this leg. This basically could go into an accumulation. So basically the same move as this, yeah? And then your next leg up out of the accumulation is either bull or bear. Yeah. We're here now. There is no advantage on either of these currencies. So I get the feeling we might come back down and retest this here and then try a price discovery back down to the downside again, because there's no reason for either of these to be stronger or weaker than the other, fundamentally. The Aussie will always have the upper hand because it's a bigger economy. But, sorry, that's the wrong bit. This is what I meant. I think they're going to come and retest down here. So that's what I think we'll probably get. Or it will be one of those elevator shafts on a fundamental. But, you know, this is what we had. Interest rate change, interest rate change. Didn't change the rates, didn't change the rates, didn't change the rates. Why the hell are you doing that then? Yeah, you haven't done that for the last 12 months because we didn't change the interest rates this time and we haven't said we're going to change the interest rates. Why would you go parabolic? Nothing's happened that's caused the Aussie dollar to be massively stronger than New Zealand. So I think we're coming down here. I just couldn't hold it anymore. Too deep. If I hadn't lost on the Aussie dollar, Aussie Swiss? What was the other one I lost on? Can't remember. If I hadn't lost on that one, I probably wouldn't have taken that off. I made my money back on the US dollar yen trade on the intervention, but the other one that I lost on, which I'm pretty sure was Aussie Swiss, if I hadn't I probably would still be in this. But obviously still in drawdown because for 3 weeks we've literally sat sideways, haven't we? But yeah. Yeah, I read your comment late, yeah. Have you had success ever trading the DAX? Yep. This is the stock index hedge strategy. This trades the DAX. 7.89% this month so far. But it trades all stock indices. Again, all on the website. Everything you need is on the website. Yeah. SIH and opening range breakout EA, they're both stock index strategies. Do you think the broker would ban or restrict somehow someone that makes money having a large account? No. If you had enough money, what would be the upper limit to keep an account to trade? Upper limit you keep into an account to trade? I don't know. Your broker's not going to restrict you making money. Yeah, if you make money, they make money. They're not going to stop you trading. Basically, the larger amount of money you deposit with your broker, the larger amount of money your broker makes. Yeah. So they're not going to, if you turn around to your broker and say, I want to put £1 million in, they're going to go, yes, please. I'm not going to say no, because they make more money. Yeah. Every time you press the button, yeah. Every time you press the button, they make a commission, a spread, and a swap. Yeah. If you press the button with $1,000 in, they make X. If you press the button with $1 million in, they make X times 1 million. Or not, times 100,000 or whatever the is. But their job is to get you to press this button. The money in your account is irrelevant to them. They make a percentage every time you press the button. There is no upper limit. There may be an upper limit for you from a regulatory perspective, for being classed as a professional trader, but you are trading a CFD with your broker. So you're not actually trading the stock market. You're not trading any market. You are trading a contract for difference with your broker. So they are quoting you a price and your contract is for a different price. That's it. So the money at the end of the day is irrelevant. Whether they farm your order to the dark pools or whether they take the other side of your position is their choice. Either way, your money is segregated, so it doesn't matter. But personally, I wouldn't put more than half of my money in a broker, in an individual broker. I split my money over different brokers. I always have done. And I've always used a percentage of my money in a broker because I don't want to put it all in one basket. I got hit in the Swiss franc peg removal and I had all my money in Alpari UK, who went bankrupt. So I got stuck, couldn't trade for 4 months while I got my money back out of the FCA. That taught me a lesson. Do not put all your eggs in one basket. I don't know what the upper limit is. I haven't got there, put it that way. And I don't think I'll ever get there. I'm not going to have that much money to trade. If I had that much money, people have asked me this before. If I had $1 million to trade with, do you know what I would do? Sit on a beach. Because this is the hardest job in the world. I would much rather, if I had £1 million, not do this. Seriously. Money makes money, but there's a limit to really, if you can make enough money so you don't have to work again, it's called living. Years ago, I bought an EA called Forex Hacked Martingale, just entering at movement in one direction, deadly, yeah. I've bought those. I've bought so many Martingale EAs over my lifetime, and they all look great until they don't. There's one tip. All these EAs you find on the marketplace, yeah. So if you go and look at any EA on the marketplace, look at all these experts, you'll find that they all have a signal. I don't. And everyone asks me, they go, new live signal. That's the word that's important. New. So why is it a live, new live signal? Where's the old live signal? Oh, it blew. Right. So look at the signal. How old is it? 31 weeks. Now, why has it done that? There's always something, right? It did absolutely nothing. Look at the lot size that happened there. And at some point, it will blow. And if you look at the drawdown on them, or let's draw down here. How big's the account on this one? Right, initial deposit, €1,000. Maximum drawdown, 1,188. Yeah, it's already drawn down 100% of its account. Luckily, by the time it got there, it hadn't blown. By the looks of things, it had made enough money to withstand the drawdown. So it's up to 2,700 balance. But look at the drawdown. It's martingale. Go look at the trading history. 3, 4, 5, 1, 2, 4, It's only trading gold, but look, it takes a single, takes a double, takes a triple. Takes a single, double, a triple. Martingale. That's why the signal is only 31 weeks old. And something, I don't know, you'll have to have a look at it, but they're all the same. There's always, if you look into them all, either that is martingale, that is astronomical, yeah, like ridiculously big, the drawdown, i.e., if you get in at the wrong time, it ain't happening. Or there is a outlier, and that's what I mean by an outlier. Made a little bit of money, made a massive loss for weeks and weeks and weeks and weeks and weeks, and then suddenly, for no reason whatsoever, it suddenly made 175% return. Why? Yeah, either that's lucky, an outlier, or something happened there that caused that, which isn't going to happen again in the future. Something's wrong. 99.9% of everything you see on here will be exactly the same. If you go and look at any of the EAs, Quantum Emperor, this is $1,200. New live, new. Why is it new? 12 weeks. Reliability. Yeah. It's only been going for 12 weeks. Lucky run, 50% increase. Good job. You're doing really, really well until, boom. New live signal will be reduced. Will produced when it blows. It'll produce a new live signal. Drawdown. Unbelievable drawdown. You'll probably find again trading history. 5, 6, 7, 8. So it's using an incremental lot multiplier, which is better than martingale. But, you know, that is all you find on this marketplace. Yeah, which is partly why I do what I do, to break all the myths on all this crap. None of it works. None of it works. You go and buy this EA. Yeah, it's been going for 3 months and it's made a 54% return. There isn't a consistent trader on the planet that makes 20% every month. If there was, they would be employed by Warren Buffett. And Warren Buffett would be sitting on a beach somewhere drinking a Mai Tai, because he's got a guy that can produce that on $1 billion account. Just doesn't exist. It is the Holy Grail, and everybody will show you the Holy Grail until the Holy Grail is not the Holy Grail anymore. And then all of a sudden, back to square one. What of your systems work the best with crypto? No idea. Don't trade it. Herc, unless you can explain in detail to me what drives the crypto market, which you can't because nobody knows, don't trade it. I have no idea why it goes up and down. Just realized something. You mentioned 160 on UJ was way off your charts. No, 160 was where the intervention happened. It's there. That's 160. 145 was way off my charts, which was the original intervention. The original intervention was back there, look. 145. That is what we were expecting, and that's what we got. That candle there, you can't see it, it's absolutely tiny, but that was an intervention. Look, 150, sorry, 145 there. So that was the intervention we got. It failed. We then got a second intervention at 150, and it got hammered home. Same way as it did before. When we got back to 150, we got a small intervention move. Wasn't big enough to hold, and the market pulled back because we got continuously threatened at 150. Then the market pushed up, sat there for ages, dropped away and pushed through it. And this is where we were on this run up to 160 that nobody knew was coming. That's where we got the intervention this time. Historically, what will happen after an intervention is that. Yeah, you'll get somewhere between 4 to 8 weeks of drop. That's just what happens. Typically. But this is not typical at all. This what we're in now is just not the same because the interest rates now are different in Japan. So You love trading, really? I do love trading. I don't know what I'd do if I didn't. Walk the dog, go on holiday a lot. Yeah. This isn't my chosen profession. My chosen profession would be lying on a beach. Those grid systems will work better than stop losses. They just need drawdown control. Yeah, well, what is drawdown control? Stop loss. It controls your drawdown. If you use a grid system without a stop loss, you won't get a chance to do drawdown control. Yeah. The reason position trading works is because the entries are not at set distances. Pound New Zealand, I think, is I've only got 3 on. This is the biggest I've got. So there's the first entry, there's the second entry, there's the third entry. The distance between those entries is not the same because I got in here because the market collapsed through and then pushed. Yeah, I didn't get in there and here because that was a distance. That's a grid. Yeah. I would now here be in 4 positions instead of 3 positions using grid trading, or maybe even more. I don't know. It depends what your grid is, doesn't it? But if you get in with strength, that's fine. But drawdown control on something that does that is still not going to work. You know, you'll just be in bigger, deeper, faster with grid trading. Yeah. It's very similar to position trading, except with a position trading, we are using an entry criteria that is stretched before we enter, and we're using market strength to signal an entry rather than just getting in for getting in sake. But I have never tested a grid trading system with drawdown control. It may well work, but then it's not a grid trading system because they don't use drawdown control. It's position trading, isn't it? A hybrid, I guess. I don't know. I have that EA legit. What EA? What, the ones I've just showed you with the signals that are new because they blew the accounts? You've got that one. Google. What are 3 things traders consistently... What are 3 things traders can consistently do to maintain longevity and consistency in trading? Mastering one strategy, then eventually building a portfolio of strategies. Could do. The one thing you've got to do is go and watch the bootcamp on the website, which is all free. Go and watch that. That's the first thing you need to do. That will make you consistent, because it will show you what not to do. But you can't. Consistency in trading comes from repetition. Yeah. Longevity and consistency is born out of repetition. You do the same thing over and over and over and over and over and over again. As long as it makes money, you just keep doing it. Yeah. If you consistently try to improve on something, you will curve fit it to a point that is not consistent. Yeah. The market has 3 states: bullish, bearish, and not going anywhere. There are only 3 things every candlestick can tell you. I've gone up, I've gone down, or I haven't. Yeah. None of them have any bearing on the future whatsoever. So if you look at a daily chart of anything, so yesterday was a bull day. What is today going to be? I don't know, but that's got nothing to do with today. Yeah. So the first thing you got to do is let go of systems and strategies, because none of them work consistently. There isn't a consistent strategy. Yeah. You can have multiple strategies that have a percentage of consistency, but the market is either in a state of accumulation or range. It is in a state of breakout, which will become a trend, or fail. Yeah. Those are the only 3 states of trading: range, breaking out, or trending. Those are the only 3 things it can do. So if you have a really good trend strategy, yeah, that will work around about 30% of the time. 70% of the time, it will either break even or lose money. You can have a range-bound strategy, which will work somewhere between 70 to 80% of the time, but it will only generate a risk-reward ratio of something like 1.2 to 1.5, so it won't make you an awful lot of money. The breakout strategies are kind of a hybrid. A lot of people will do a mean reversion breakout, or they will try and break out into a trend. Either way, the strike rate on those is roughly 50-50. With breakouts, they either work or they don't, because when you break out of a range, it will either trend or mean revert to the range. So the strike rate on breakout strategies is roughly 50%. So if you go with a 2-to-1 risk reward ratio on a breakout strategy, you'll be fine. There are only 3 strategies on the entire planet. The market can only do one of those 3 things. How you decide to get into the system, the market regime that you think a instrument is in, is entirely up to you. You can use an oscillator. You can use a moving average. You can use an indicator like the market reversal alerts to signal strength in a direction. You could use a propulsion gap indicator to signal when there is a possibility that an order might trigger. You could use a support resistance indicator like this one to indicate when it's likely to pull away from a level. But all of those will be giving you one of those strategies. It's either going to be a mean reversion, a trend, or a breakout. Those are the only 3 things that the market does. Yeah. So if you have a good trend strategy, a good breakout strategy, and a good mean reversion strategy, couple those 3 together, every day of the week, you will make money. Simple as that. You don't know which you need to use. So, and this is where everybody goes wrong. They try trend trading. It doesn't work. So they skip to range trading just as it trends again and doesn't work. And they go, well, I'm going to be a breakout trader and I'm going to take shorts when it retests there, when it goes into a range. And they go, well, it didn't get down to my target. I'll move to break even and get stopped out. They make no money because they are flipping between this strategy, that strategy. If you just come in every morning, open up an hourly chart at 8 a.m., flip a coin, heads, press the long button. Yeah. If at the end of that day it's in profit, shut the trade. If it's not, take another trade in the same direction. At some point within the next week, you'll probably get out in a profit. There's no strategy because it's random. The market will do one of 3 things. That's it. What you spend your life doing is looking for the strategy that has a high strike rate and very rarely loses. That doesn't exist because the market regime and the way that the market moves changes on a regular basis. Everybody that was range trading here took a short there. They lost. I took a short there. It didn't work out. So I took a short there. It didn't work out. So I took a short there. And then I got out of my trades. Position trading works in a range breakout that either works or fails. Range trading works all the time because we're mean reversion trading. So when we get in at the highs, we expect it to come down to the lows. Trend trading, when something goes into a trend, works as mean reversion because if I get into actually I don't trend trade. So, but anyway, but if you get in the wrong direction and something goes into a trend against you and you go long and it starts to trend down, you can go long again. And if it trends down further, you go long again. At some point, it will go back up into the mean, in which case then you can get out with no loss. Yeah, which is why I trade the way that I trade, because my style of trading works in ranges. It works in breakouts that work. It works in breakouts that fail. And it works in trends. As long as a trend moves up and down with market structure, there's always a way out. It doesn't work when the market goes into parabolic squeezes, in which case I take a loss. Even my strategy doesn't work in all market conditions. It cannot survive parabolic moves. Parabolic moves are very, 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 very rare. Every other condition I've just explained happens all the time. So you use a strategy that is designed to extract money out of market movement, but not predict market movement. Because unless you have a time machine and your name is Doc, you don't know which way this thing's going tomorrow. So how could you possibly predict it? You can't predict it. You just have to get in and wait and see if it goes your way. If it goes your way, you take the money. If it doesn't, you move your price. That's all you can do. That's what banks and institutions do every single day. It's called DCA, dollar cost averaging. This resistance worked all of those times. This one, it overshot by that much. This one, it hit it to the pip. This one, it overshot by that much. But that resistance worked every time. Now, if you're a resistance trader using lines, there you would have gone, it didn't work. There you would have gone, it worked. There you would have gone, it didn't work. You skip on to the next strategy because it's only got a 50% strike rate. Rubbish. It's not. It's spot on. Resistance is an area. It's not a line. Again, all this stuff you only know once you've seen this thing do it 1,000 times. This support bounce worked 3 times. Didn't make any money out of that one because it collapsed. I'm in this long. Look, I got in there. Totally wrong. Got in there. Totally wrong. Got in there. I had a break-even average yesterday and I've had a break-even average today. I'm looking for it to move up to there. So I'm what? Week and a half into this trade? I haven't lost any money because I'm not trying to get it right. I'm just waiting for the market to move in the direction I've asked it to move in. It's being stubborn and doesn't want to. But wait. But there's not 3 things that can make you consistently profitable. The one thing that makes you consistently profitable is not placing an order in the market underneath a low where you lose a percentage of your account. Yeah, that's how you lose money consistently. You go short, brilliant. It hits that level, you go short, brilliant. It hits that level, you go short, you place an order there to say lose 1% of my account, please, and it loses 1% of your account. Why would you ask the market to take 1% of your money away because you got the wrong level of price changing direction, which you can't predict because it's driven by a completely random force? That's what you do consistently. That's all you can do consistently because you can't predict the future. There is no time machine, as John Wick says. He never said that. I just made that up. That's it. It's all the market does. It goes up, it goes down, and it moves through time. You can't predict whether it goes up. You can't predict whether it goes down, but you do know it's going to do those 2 things over a period of a number of candlesticks, which is completely random. So all you do is you wait. I got in short there. Yeah. And I got out there. Did I get the entry right? God, no. It's absolutely ridiculously wrong. It went up for the rest of the day and then it came down and it didn't even get back to my break even. Then it did. Did I take 1% loss of my account? No. Why would I do that? That's stupid. That's how you get consistent. By not trying to be right. Because you can't be right. It's impossible to be right. Yeah. Predict what the weather is going to be in 6 weeks and 2 days and 3 hours for me. You have no idea. But you got a good chance it's either going to be raining, it's going to be sunny, or it's going to be cloudy. Yeah. What's your odds? 33% of getting it right. Take those odds. If it isn't what you predict on that day, pick another one for tomorrow. Pick another one for the next day. Well done. You win. Just because you don't get it right first time doesn't mean you're wrong. It means you're temporarily wrong. You just got to wait to be right. That's how you make money in the markets. You don't try and be right. Everybody's trying to be right. Pick the top, pick the bottom. You can't pick the top and the bottom of something that moves at random. Possible. You can predict based on historical information. So I can say with a high degree of accuracy that when the market gets to the high on the RSI, it drops. Didn't there, did there, did there, did there. So why do I use this indicator? Because it's right a lot of the time. When it's not right, I just wait for it to be right. Because it wasn't right there. I know the strike rate is not 100%, but I know the strike rate is above 50. So if that one's wrong, the next one will be right most of the time. And if that one's not right, the next one will be right. So all I've got to do is stay in the market until one of them's right. Which one's going to be right? I couldn't tell you. The next time this goes up here, it may be right. It may be wrong. I don't know. But if you don't know, I don't know. Why on earth would you put an order in the market to say, if I'm wrong, just take my money? That's ridiculous. It's not gambling, this. Not walking into a bookie and going, right, there's a red team and a blue team. I'm going to bet on the red team. If I'm wrong, you can have my money. No, I'm going to bet on the red team winning at some point this season. There's 20 odd matches. Yeah, I'll take those odds. And every time I'm wrong, I'll take another bet and I'll take another bet. You could do martingale with that, obviously, but that's what gambling is, martingale. That's exactly what you do in gambling. But this isn't gambling. This is, and they shouldn't even call it trading. It's not really called trading. It should be called extracting money from the market. Yeah, because all the market does, go and open any chart, yeah, and just draw at random what the market's doing. Yeah, it went from there down to there, moved up to there, popped down, screamed up, dropped, went up, dropped, went up, dropped, went up, dropped, went up, dropped, up to there, dropped to there, up, down, up, down, up, down, up, down. Where's it really gone? Look at where we started. Look at where we are. Where's it gone? That was February the 5th. We're now on the 13th of May. 3 months. Where's it gone? It's went up and down. So if you know it goes up and down, but you don't know when it's going to go up and down, what can you do? Wait for it to go up and then wait for it to go down. So if it goes up really fast, get in short. And if you're wrong, you might have to wait until it's got up to there before it comes down. But it will, because that's what it's done for the rest of its life and what it will do for the rest of its life and what it has done forever. All it does is it goes up and down. Sometimes it goes up and down in a trend. Yeah. So if you get in short and you don't get out there, you get in again and you get out there. And if you don't get out there because you got in there and you missed that, you get in there and you get out there. And if you don't get out there because you got in there and you missed that, you get in there and you get out there. And all of that is profit. That's a loss. That's a break even. That's a profit. That's a profit. 2 profits, 1 loss, and 1 break even equals a profit. Was I right? No. Was I right? Yes. That's all it does. Every now and again, though, it will do that. You're going to get hurt. There's nothing you can do about it. But that is no different to you getting into a trade and it's going long and you taking a stop for 1%. Yeah, going long again, it going down, you taking a stop for 1%. Repeat that 10 times, you've lost 10% of your account. Yeah. So you get a losing streak of 10. Happens all the time. Then you'll get a winning streak of 20 or whatever. It doesn't matter, does it? But you will get stopped out X number of times and lose X% of your account. If I get in short there, and short there, I have lost nothing. When it goes down to there, I win. So what am I eliminating? Loss. Every now and again, it will go to a point where you're like, holy crap, this just isn't stopping. I'm in 10% of drawdown. I need to close it. The number of times it does that a year, that far outweighs using a stop loss. Yeah. Because all these profits that you've made waiting for the market to move in your direction, when you do get those big losses, 2-3 times a year usually, everything else has been paid for. That's how you become consistent, by not trying to be right. All it is. It's you. I can't be right. Go and look at every analyst out there right now. Now is a perfect time to be looking at this point. On this feed on Financial Juice, you get Kashkari from the Fed coming out. On Powell speaking. There we go. Look. You get Kashkari coming out and saying, I think the interest rates will come down in September. 10 minutes later, you get Not coming out saying, I think the interest rates will go up in September. 2 hours later, Bailey or someone else comes out from the Fed, Powell comes out and says, interest rates aren't going to change until January. If they don't know what the market's doing and they influence the direction of price, how on earth do you think you have any chance of predicting where anything's going to go in the future? You can't do it. It doesn't care what anybody says. You can show me systems and strategies and things and dashboards and everything will fail. But it will also work. But if you eliminate the need to be right and wrong, all you're left with is a direction. And it will go in that direction at some point. And that's it. All you know. You just got to be careful with risk. And all you can do, if you can't influence price direction and you can't influence when the direction will be happening, the only thing you have in your control is risk. So if you use a lot size that is so small that if it moves that far against you, it makes very little difference to your account, you don't care. Reduce lot size. You're not going to make a fortune. No one ever said you were going to make a fortune. Well, all the Lamborghini hunters that are selling courses told you you're going to make a fortune. You're not. Banks and institutions make less than 10% a year. Yeah, because they don't risk ridiculous amounts of money on random events. There's only 10 banks and institutions on the planet that can move these candlesticks up and down. They do not agree with each other. And for one of them to make a trade, they need another one on the other side going the opposite direction. So while they're doing that, someone else is doing that. They are pushing and pulling constantly against each other because they disagree. They have to, because if they all agreed, who the hell are they going to sell to? Yeah, if all the banks suddenly went, we're all going long, there's no one up there. The order can't take place. So the banks have to move it up and down. It's called profit taking. You push it down, you pull it back. You push it up, you pull it down. You push it down, you pull it up. And if you look at this, going back to the first thing you learned in trading, the first strategy you probably found that had any modicum of success, it was probably called a Fibonacci. And that's because it uses pullbacks and it will either go back 30, 50 or 61.8. Because when the banks are in massive amounts of profit, they'll take a percentage of it off. Roughly a third, roughly half, roughly 3/4. I don't know, let's just get out the whole thing and call it 100% a V-shaped recovery. Why do you think Fibonacci ratios work? Because banks and institutions can't stay in the same direction all the time. Otherwise, they would just get bigger and richer and bigger and richer and never actually realize profit. That's what realizing profit is, mean reversion. Why the market spends 80% of the time in mean reversion? Because they have to take profit. Very, very simple when you know the mechanics of why it moves. That's what you need to learn, why the thing goes up and down. It goes up and down at random based on bank and institutional money movement and management. Yeah, that is a large order placed by the bank. That is a large order placed by the bank. So was that, so was that. Every time there's large orders placed by the banks, they come back to the levels they place the orders at because they need equilibrium and they need to take profit. So if they leave a big order there, they'll come back and they'll test it. They'll either add more position to it or they won't. It sounds really simple. Doing it is the hard bit. Yeah. Because doing it takes time. When you get into something and you're sitting in it 2 weeks later, it's frustrating as hell. And it causes people to fly off and do stupid things. This is where you sit on your hands. This is why I do what I do. Because I'm talking now, I have no idea what's going on in the market, but I'm pretty sure my P&L is pretty much in the same position it was at 1:15 when I started the stream. There's nothing to do. That's what trading is. It's sitting here watching paint dry. That's the reality of it. Anybody that sold you a high impact, let's buy a Lamborghini job, they ain't doing it. There you go. So there's more than 3 things you can consistently do to make profit. How much capital is ideal for position trading? So you're going to make roughly 10% on average per month. Yeah. Look at the average return, average monthly profit, 5813. This is based on a 50K account. Yeah. So on average, with a position trading strategy, you'll extract roughly 10% out of the market a month. Double your account a year. Yeah. So again, real world trading. Yeah. If you want to make 100K a year doing this job, what do you need to start with? You ain't got it, you ain't going to make it. Simple as that. You can't make more than that because you haven't got the capital to do it. If you want to make 100K out of a 50K, you've got to be 2x aggressive than you should be to make money. If you want to make 25K into 100K, you're going to have to be 4 times more aggressive. 4 times risk comes with 4 times the chance to blow your account on a bad move. Yeah. So if you go somewhere between 5 to 15% is very typical. If you're going back and look at all my past streams for the last X number of years and go to the last stream of the month and look at the P&Ls, which are all on the screen. Yeah, so you'll see my P&L here on the screen. You'll see they range wildly, but usually somewhere between 5 to 15 is typical. That's safe. So, you know, it is what it is. Yeah, if you want to use a stop loss based strategy that tries to get 10 Rs, that's brilliant. But bear in mind, you're going to take a 9R loss to get that 10R, which is why it doesn't work. And why you pick up strategies and you run with strategies, because the strategy you pick up that gives you the 5R return on your first trade, you will stick with that for months. It will never replicate what you just did, but it will stick with it for months because it showed you potential. But consistency comes with very small lot size and very wide stop losses. Very wide stop losses mean you cannot get the risk reward ratio of 10R, because this thing will sit and it'll move up and down 2 ADR for weeks before it decides to move on the next fundamental news event. Yeah. So if you go long here and you put a stop loss there, you're going to die. If you wait for it to go down, you go long and you put a stop loss somewhere, you're going to die. Look, if you went long here on that reversal and put a stop loss there, look where you are. You haven't gone anywhere. You might be about a 2R after 3 days of sitting in this thing, getting frustrated, and every time there's a bear candle, papping yourself because it looks like it's going to go the other way. So I'll put a break-even stop, take the break-even before it flies. That's what we do, isn't it? Any order you place in the market to get you out of the market is usually the wrong one, including take profits. Yeah. See my take profits here, right? The reason they're there is because the market sold from that level twice out of that propulsion move. So I know there's a hell of a lot of sellers right there. If we get there, I want to be out in case the sellers are there. You watch when we get there, what happens. Some point in the next week, we'll be there. Almost guarantee it. But I can either have massive balls or I can have money. I'd much rather pay myself and pay the mortgage than take a chance that it gets there in the next week. It could get there in 6 weeks' time. It could not get there. I could be totally right and it bounces from that high, and if we find out we're down here next week, I have no idea where this is going. Neither do you, neither does the bank. The people that move it do not know the volume of orders at that level shorting it. They know they're there. They do not know the quantity. So when they run at this level with 500 million and run into a brick wall of 2.5 million or 250 million, yeah, they will lose. If they run at this with 500 million and there's 100 million sitting there, they'll pop straight through it like they did there. But they do not know until they reach that level. If they don't know, how can you know? You just got to take money. When the opportunity presents itself to take money, you take money. That's it. That's trading. Your job. Yeah. If you've got a market stall and you've got a punnet of apples and you bought them for 50p, right? And a guy comes up to you and says, I will give you, or you say to them, I want £1.50 for this punnet of apples. Yeah. And he says no. And you go, I want £1 for this punnet of apples. And he says no. And he walks away. Next guy comes along and you say, I want £1 for these. And he goes, no. Then you drop it down to 75p and the person says, yes. Take the money. What have you just made? 25p. If you don't take the money and the next guy comes along and says, I'll give you 40p, you're going to make a loss. And if you turn that down because you don't want to make a loss, what's going to happen? They're going to go rotten. What do you lose? Everything. Take money. When the money's there, you take the money. Doesn't matter what the money is, you take it. It ideally wants to be more than you've risked on the trade. But who told you had to do that? Who said, if I risk $500 and the market pushes up within 24 hours to $400, I can't take it? The idiots that use stop loss and risk reward told you that, didn't they? Take it. I'm going to go and spend it in a restaurant this weekend. Why would I not take it? Mental. Everybody's taught completely the opposite of what all the banks and institutions do to make money out of this thing. And I've no idea where it all came from, but somebody somewhere at the beginning of trading on the internet came up with something that was completely wrong, and the market grabbed it and went, yes. Mad. I don't know where it came from, but they did. Have a look at the that EA first. EA again, you got drawdown control. You got DD wrong, and it's not a new signal. EA is making me a lot of money, and the DD is nothing like you said. Okay, that's cool, Dougal. You stick with it, mate. All I'm saying is, for 15 years, I've been on that website, bought everything, followed every signal, and I've never found one that works. But if you think that is it, that's brilliant. It's having a great run, and I'm sure you'll be fine. But, let me know in a year's time if you've got a P&L which is generating 54% in a quarter, because I will buy it off of you. I'm not lying. I will buy it off of you for $250,000, because if you found something that does that, I'm a millionaire and I'll have it. I can guarantee you won't be coming back to me though. But anyway, you'll follow your path. I have a question. Which broker or data do you use to backtest? I use my IC Markets. It's not accurate. I use Dukascopy, but what's accurate? How do you define not accurate, Yusuf? The way that I define accuracy is, this is my broker's chart, on Robo Forex. If I run a backtest in here in visual mode, which you can't see behind my head, using data from a broker, right, and it paints virtually the same as this on my chart, it's accurate. Because if it mimics what my broker is showing me within X degree, it's accurate. Yeah. So what you do with your data, which broker you choose as your source of data, if it isn't the broker that you trade with, obviously, if it matches how your broker has, so the best way to do it, I use an hourly chart, and look at an hourly chart going back. This is 3 months, and then run a back test in visual mode. Let me just get these results out. One sec. Euro US. So if you run a back test on Euro US, let's do that. Up to well, I won't do it now exactly, but pick this time frame from 24th of January to date, and run the back test in visual mode without optimization turned on. On an hourly chart. And just obviously pause it. Right. Scroll out so that you got the same zoom level and compare the two charts. So flick between the two charts. If they look the same, the data that you're testing with is pretty much what your broker gave you, what your broker's going to give you. If the data is wildly different, the candlesticks are in different places, the open, high, low closes are in different places on dailies, the data is not the same. That's accurate. That's as accurate as you're going to get. And don't forget, what you see on this chart from there to there is never, ever going to happen again. This is unique to this period of time, and the actual movement of data on this chart, the movement of this pair, is never going to be replicated again in the future at all. The way this drop went from there to there over that period of time, using that many spikes up and down, and the distances it moved every day, and how it moved every hour to get to those distances every day over that time, will never happen again. And it has never happened again in the past. So everything you're seeing in this back test is just for testing a thing happens regularly, and there is a set of parameters that it doesn't matter what you use, roughly it should extract money. if it continues to use the same characteristics it's shown in the past to some level of accuracy, 40, 50%, again in the future. That is the best you can hope for in backtesting. Yeah. I challenge anybody out there, right, to take a screenshot of any chart and then go and find me the exact instance of that happening again in the past. Even 50% close doesn't happen. Yeah. It just doesn't happen. Yeah. You may have seen a pattern that was, I don't know what the ADR is on this, but let's say that is 2 ADR. There may have been a pattern where it took 9 days to move 2 ADR from top to bottom, but you'll never find intraday it getting to 2 ADR in the same way. Therefore, any pip of stop loss or take profit that you have on that chart will never happen again. So this is why I do system parameter permutation tests. That is why they are useful, because if I say I'm going to get in when it gets to X, let's say there's an oscillator down there that signals an entry, and I'm going to get out at Y, and my Y is there, or there, and every single permutation of that test is profitable, it tells me that if I get in when X happens and I get out at some point in the future from there to there, it makes money. That's as best as I can hope for. If I can get that thing to repeat itself 50% of the time in the past, there's a high probability it will happen again in the future, which is why oscillators are so good, because they are, especially RSI, because it measures relative strength of movement. So if this thing gets above a level, right? So the reason I'm using 90-10 on the RSI 2, the reason I use that, not 80, not 70, not 60, I use 90, is because it very rarely happens. But it happens with a 60 to 70% strike rate historically on every instrument I've tested it on over any period of time in the past. So if I know that when a line goes above a line, there is a 70+% chance, yeah, that the next move will be down, that's an edge. And it's happened 70 out of 100 times. So, okay, that might be a fluke on the Euro US dollar. So let's test it on Aussie New Zealand. Let's test it on Euro Pound. Let's test it on US dollar Swiss. Let's test it on oil. Let's test it on gold. Let's test it on the S&P 500. If that happens, it's robust, because it's not instrument specific. It's not time frame specific. Test it on the hourly chart. Test it on the daily chart. Test it on the 4-hourly chart. If it works on all time frames and it works on multiple instruments, it's bloody robust. If it doesn't, and it only works on the Euro US dollar on the 15-minute time frame, it's curve fit. It's never going to work, ever. And that's what 90% of what you will find out there is. If there is something that only trades gold, yeah, it only works on gold historically in back tests. Yes, it will have a run for a while. No, it won't work consistently, because it's curve fit. Curve fitting is the reason everybody fails. Everyone comes up with a system or a strategy. They back test it for 3 months and go, found it, found the Holy Grail. Because every single time on this chart, it worked. Yeah, what they've forgotten to do was go and look at that. Oh, it failed 50% of the time. Oh, only worked 10% of the time. Go and look at ADR. Yeah, look at this. Volatility. When volatility is high and when volatility is low, if something produces the same result, it's robust. If it only works when volatility is up there and when volatility is down here, it doesn't work. It's not robust, but it doesn't mean it's not useful. If we have a high volatility, high ADR, we can use the strategy. If the ADR drops below X, we stop trading the strategy. That's a filter. Easy to do. But all of this is all done by backtesting. But it's only going to tell you what happened in the past. This has never happened ever in the past. Yeah. A bear volatile market for 12 months. We haven't seen one. Yeah. And it's following a pandemic. We've never seen one. It's following the biggest bull run when businesses are shut and making losses that we've ever seen. It's never happened. That's never happened. That's never happened. That's never happened. Highly unlikely any of that will ever happen again. If you base a strategy on that, ain't going to work. Yeah, just not going to work because we're not going to get this happening again. Right now, the S&P is looking like that. Is it going to do that again, or is it just a pullback like it was here? We don't know. Yeah, which is why you can't base any systems or strategies on historical information with any degree of accuracy. It's got to be something like this, where you get a system, you test 250 different stop losses and targets. And if every single one of those works, there's a high probability it will work in the future. If 10 of them work and the rest of them fail, and you pick one of those 10, it's an outlier. It's just so unlikely it's ever going to work. But there is a probability it will have a lucky run at some point. Yeah. Which is why you find all these EAs that have a signal attached to them. Like that. Yeah. They show you the signal, they take it away. They start a new one. When it goes wrong, they start a new one. Don't forget, you've just landed on this. You've never seen it before. You've seen an advert. You've found it. It's like, oh, that looks good. Wow, look at that. 12 weeks. It's made 175%. Wow, that's brilliant. It's been going for 6 years. Yeah, it's done this 70 times. When you go into it, what the hell? Where's my profit? I just hit the bad bit. Here you go. Start again. Be all right. Does it sound familiar? Because that's what my experience is with them anyway. But if you found one that's brilliant and it lasts for a year or so, then fantastic. There are some out there. There are a couple out there. And do you know what? They don't use stop losses. Funny that. No. But equally, they are incredibly low risk. Like, you'd need a serious amount of capital to make money out of them. A bit like the banks do, yeah? Anything you see on DarwinX, all of their Darwin AIs, they're all brilliant. But they all use tiny risk. Yeah, 10, 20% a year maybe. But if you've got $1 million, that's all you need, isn't it? We haven't. I wish. Did you ever test the POS EA running just through London? And no. No, never done that. NQ just ran last week's high. Good. You just made money. Good one, Brian. So I'm out of NASDAQ. I'm out of the S&P. This is what I mean. At the moment, we are getting clean breaks all the time. It's lovely, but they're not going far. Yeah. We've had a couple of days where we've had 5-7 Rs, but the vast majority, we don't get more than 3R, which is why my targets are 1R, 3R at the moment, because 3R is achievable. We got there today on the NASDAQ. Unfortunately, I got stopped out just before we got to it because I used a stop loss, and stop losses get you out of the market. That's the point of them, which is why I call them stop profits, because if I hadn't have used the stop profit order, it would have made profit. But because I used a break-even stop profit, it stopped my profit. What stop profits do. Most people call them stop losses, but that's not technically correct. Anyway, we all know that. 10% a month is 3 times the account every year. No, 10% a month is 100% of the account a year, unless you compound it. If you compound it, you can make a lot more. Yeah, and there's a difference. Yeah, compounding, again, you look at all these compounding courses, or there's not many out there, but there are compounding courses out there. And there are, again, these systems that you see, these signals that you see, don't forget they are compounding everything. Yeah. So when you get something that starts with 1,000 and ends up with 1.5 million, it's because it's been compounding all the profits. And the lot size is getting bigger and bigger and bigger and bigger and bigger and bigger until it's a massive lot size that takes a really big loss and undoes the entire thing, which happens sometimes. Yeah, there's a reason you don't go super massive, because your losses are exponentially increased as well. But if you're doing this as a job, you can't compound because you've got to pay yourself. So if you start with 100K and you build it up to 110 or 120K, 20 to 30% is where I like to take a profit. Once you've done that, you go back to 100. Yeah, but you can use that to compound for a short period of time. But when you withdraw, you're going back to old lot sizing. Yeah, that's what your P&L really looks like, because you've got to withdraw money. You've got to pay yourself, don't forget. You see what I mean about it being the hardest job in the world? Yeah, and I'd much rather sit on a beach. It's not easy. You cannot buy a Lambo. I know that because I haven't got one. Porsches and secondhand are about my limit. Glad I got out Euro US dollar. Because when I apply it on a quant analysis, some months it says 0. The question actually is, how do you do your back test so you can't get some errors or missing data throughout the testing? So I use Tick Data Suite. Yeah, I mean, if you've got holes, then either there was no trades or there's a massive gap in data. If there's a gap in data, you've got a problem with your data, getting you different data. The beauty of Tick Data Suite is there are a load of data feeds in here. Yeah. From big brokers, DarwinX, FX Open, RAN, FXCM, Alpari, Dukascopy. Huge brokers who have been around for decades. Yeah. They got the data. It is what it is. I use Dukascopy because I've never had a problem with it. Simple as that. There is no right or wrong. It's just data. At the end of the day, it's tick data. As long as their tick data matches roughly what my tick data is on my broker, because at the end of the day, I'm not trading on Dukascopy. I'm trading on Forex. So if Dukascopy's data is totally different to Forex's, I need to use Alpari's or I need to use someone else's. But if you've got holes, then you've got holes. But in here, if you've got months where there are no trades, yeah, there are no trades. Or there's a whacking great hole in your data. You can see where the hole is if you go and look at the equity chart. You'll see a flat line before it starts again. So you know there's a data issue. But also, just double check. I mean, it's highly unlikely depending on what strategy you're using, but it's highly unlikely. But there may have been no trades. Yeah, if you're using an oscillator and it never got above or below the line, it's not going to trade, is it? So I would say there's a data issue. If you're using your broker's data, it's utter rubbish. They quote 1 minute. I mean, what you see like here, for example, on my chart is quoted to me. Historical data is quoted to me by my broker. Now, every high and low you see on this chart, yeah, and every overnight spread is not included. So when we got here, if that was a parabolic news event, price may have actually traded up there. It won't be printed there because it was spread. None of that is going to be in the data that you get from any broker, which again is why you need a system parameter permutation test. So in this case, we got to the 80 level. So let's assume that price quote traded up to there. Does my strategy still work at the 90 level? If it works at the 80, the 90, and the 70, it's robust. If it only works at the 80 and it doesn't work at the 70 and the 90, it's curve fit to the 80. What's the odds of the 80 being hit in exactly the same way again in the future? Not a lot. It hit it, just missed it there. It just went over it there, just missed it there. It hit it to the pip there, just missed it there. It's never going to hit it exactly the same way every time. And the day after is never going to follow it exactly the same way as it did the day that it hit there in the past. So this is what robustness testing is all about. Testing variances. If you've got a 10% variance and a 10% variance on your TP and your stop loss, it means that you can be right or wrong within 10% of the day's price movement. Yeah. Yeah, that's quite a lot. If you've got a 20% variance you can test, it's even bigger. Yeah, if you use a 2 pip spread, a 10 pip spread, a 5 pip spread, and a 20 pip spread in your testing, and it works your strategy and is profitable on every single one of those, it's pretty robust. Because when price moves down, you don't know how far it's going to go. But if you've got a 10 pip variation and it works every time, there's a chance it's going to work. That's robustness testing. What it's all about. You're never going to find exacts. You're going to find roughs. I know roughly after it's pushed up, it's going to come down. I don't know whether it's going to be the 70, the 80, the 90, or in this quarter, we've had 95s, almost 99s on stuff. Never had that before, ever. Didn't survive some of it. Well, I did survive it, but it had to take losses because we've never been there. In the past, my backtesting showed me that's never happened in a decade. It happened this year. How could I possibly predict it? Can't. You take what you're given. And I got given that. You know, it's just, you can't backtest everything. The only true holy grail is Monty Python's. Correct. It's the lack of data because I'm using RSI2. RSI2 has got nothing to do with data. RSI is plotted on data. If you have got no data, you'll have no RSI, stochastic, moving average, you'll have nothing. Data, everything, every indicator is plotted on data. A moving average is plotting the average price over the last X candles. A 200 moving average is taking 200 candles, plotting the average price. If you haven't got those 200 candles, it can't plot anything. So the moving average won't work, the stochastics, the RSI won't work, nothing works. There'll be no support resistance lines, there'll be nothing. But I don't know. Also check how you're testing, whether you're using ticks, control points, or open prices. That has an impact. Again, I robustness test everything at tick level. So I do all my testing on control points, and then I verify all my testing on tick level. Tick level is always less profitable than control points. Virtually all the time. Sometimes it comes out more profitable, but there's a variance. I can show you actually. I don't think I've got the data in here. Yes, I have. So what I'm going to show you here are 3 different tests. Okay, on the same instrument, one using tick data, one using control points, and one using open prices only. Yeah. So if I remove the portfolio view and just show you the sub equities. Okay. So the green line, this one, is using control points. The dark line is using open prices only, and the orange line is using tick. Yeah. So you see that the equity curves are virtually the same. Yeah. Open price testing, 4 years in 10 seconds, 5 seconds. Control points, 2 to 3 minutes. Tick level, 15, 20, half an hour. Yeah. So all my testing is done on control points, because control points typically will give you a mean between open prices and tick level. Yeah, roughly. But you can see the equity curve is virtually the same. Yeah. But the accuracy of the testing is very different. Tick level is every single tick in the market. The EA is making a decision. It's monitoring profit, it's monitoring loss, it's monitoring spread, it's monitoring every element of the market at tick level. Control points is only measuring once every candle below your testing. So if you're testing on the 30-minute chart, it's measuring 15 minutes, using 15-minute candles. If you're testing on the 15-minute, it's using 5-minute candles. If you're using open price, it's literally just waiting for every candle to open and using that. So it ignores everything in the middle. So if price pushed up into there and came down and then stopped here and your TP was there, it wouldn't have registered you hitting that TP because it only took one measurement at the open, which is why you'll find open pricing is way less accurate. But if all of them come out in profit, so we started here, that one came out in profit, that one came out in profit, that one came out in profit, it's robust. Because at the infinite testing and at the most random testing, like a human being, it could make money. You've got something on your hands, haven't you? But none of that is ever going to be repeated again. So how good is it? You don't know until you test it. And this is what forward testing is all about. But you can test, this is why this is such a good tool, Quant Analyzer. It's totally free and it allows you to do all of this robustness testing in a very controlled way that gives you lots and lots of ways of viewing the information. More importantly, does it make money? Yes. That's all you need to know at the beginning, isn't it? But it's never accurate. Nothing's ever accurate. 100%. So always best you can. Yeah. It's all you can ever hope for. It's the best you can possibly hope for. Dominic thinks position trading strategies are super risky, so they adjust your risk to the absolute minimum. Yeah, they do. They are super risky. Yeah. Why do you think I'm making money? Because I'm taking high risk. I'm getting into the market and I'm not placing an order to get me out if it goes wrong. That's risky. No one ever said it was a low risk strategy. It's low lot size. Yeah. So very high volatile movement has very little impact on me, but I have risk in the market and I do not have an order to stop me. But the reason I stopped using them is because they don't get honored anyway. How many times have I shown you my stop loss being taken out on an aggressive drawdown control position when the market didn't even get 30 pips near it because they spread the market to take the order anyway? Yeah, again, that sort of stuff, not in your back testing. They spread the market by 30 pips at the news to take all the orders at the news. Yeah, not in your back testing, they didn't. That was a massive profitable win. No, it wasn't. Can't see that. You have to do things live, which is why you have to use variances, which are wide, and you just have to use randomness. And if you use a stop loss, it's just not going to work. Get out the market by all means, but put a hard order in, it's going to get hit. Yeah. I mean, it's impossible. There is no trades in a month with RSI2 strategy. I'd find it very hard to believe. Yeah. I mean, these are months. It depends what you're using. The set file I put out for the Position Trader EA uses RSI 90 and RSI 10. So yes. There were no shorts on the euro US dollar that month. There were no longs that month. There isn't a month it hasn't got a signal. That was close. I mean, the beauty of this strategy, and I think this is why Larry used it, is because the stock markets are affected by fundamentals on the US dollar. The US dollar has more fundamental movement than any other currency on the planet. So therefore, there is a lot of big movement, which is a lot of opportunity. Every time, this is what I keep saying, people that filter the news out in their strategies are mad. Yeah, I've got a news filter. It won't trade around news. What, you mean when the market's moving at its most volatile and the biggest distances it's ever moved, you're not going to trade when the money-making moves are happening? What? It's nuts. RSI2 measures volatility over 2 days. If something's been going mental for 2 days, you're damn sure the banks are going to want to take some of that. That's why it works. It's beautiful. And that's what I'm doing with the position trader strategy using H1 21 RSI and the 14 on the 4 hour, we are using swing. Yeah, so it's a swing trading strategy, basically. We're trading swings. We just don't know whether we got the swing right. Yeah, RSI2 is scalping. Once it's gone like that, we want a down day. Yeah, if we don't get a down day, we're lost. It's a scalping strategy, which is why it's got to have a stop. Because if you get a parabolic move that carries on, you will get burnt if you do not use a stop loss. Yeah. Now, Larry Connor's original version didn't use a stop loss because it was an S&P long only strategy. Yeah, he used the 200 moving average to buy pullbacks, and that's what the S&P does. It just does that. That's it. It's manufactured to go up. So you only do that. So RSI2, enter. RSI2, enter. RSI2, exit. It does not pull down. It's a bull market. It's very rarely in a bear market. We've had one in the last 4 years. We've had one in the last 4 years. Yeah. The rest of it's bull. That's why it works. But that's not how FX works, is it? So you're not going to find FX goes up and down all the time, not up all the time. So you're going to find signals in both directions the majority of months. On most instruments, you'll find it very difficult not to find you. I mean, look at this. Look, there is not a month without a trade. Yeah, forget these zeros. These are the back test ended March 24 and it started April 20. Yeah, so these zeros are not the test. That's where the test starts. That's where the test ends. There's a $299 loss and a $28 loss there. But this trades. It's not going to not trade. It can't. What we're saying is all the strategy is doing, it's very simple. Have we had 2 days going the same direction? Yeah. We're up here. That's it. Yeah, it's like the 3 up day and the 3 down day strategies. It's a very well-known strategy as well. 3 up days, short it. Take a second maybe. Get out. Mean reversion, 50%. Push. That's what it does, isn't it? Push, 50%. Push, A-shaped recovery. Push, 100%. A-shaped recovery. Push, 50%. That's what it does. Pushes up and down. So yeah, it's not going to... So you got a data problem there, Yusuf. So I don't know what it is, but choose a different tick data. Maybe. All I can recommend on that. I don't know. But you will find the reverence coming back to what you said about Darwin X thinks position trading strategies are super risky because they're an investment platform. They're not a trading platform. People keep coming to me and saying, have you seen Darwin X's prop firm? It's not a prop firm. Darwin AI is not a prop firm. IA. Darwin IA is not a prop firm. It's an investment. They have multiple risk criteria applied to your account. If they deem your account to be within their risk parameters, they will fund you. Yeah. But if your system or strategy makes more than 5% a month, it's high risk because that is not what investors want. If you're an investor, you want to get 10% back on your 20 billion every year. If you can get 10% back on your 20 billion a year, brilliant. But do I want to risk 10% of my billion? No. Yeah, they're an investment. Think billions, yeah? Think Bobby Axelrod. That's them, Darwin. It's not a prop firm. Same as Axie Select. It's not a prop firm. Yeah. They are looking for safe, consistent, time-based strategies where they can run a risk analysis on it as they would with everything else. They're looking at basically all these firms do that give you these money, proper prop firms. They take your P&L, yeah, back testing, they're not interested. I've got this brilliant strategy. But I don't care. Stick it on account for 6 months and let's have a look at the profit curve. Well, I can't do that. Why? You go then. Not interested. Yeah, they want your P&L. Yeah, and your P&L, if it goes into drawdown by 15% to make 10%, off you go. Not interested. What do you mean I'm going to risk 150 million to make 100 million? That's far too risky. Yeah, I would rather make the money than and take the heat. That's the way that I like to trade. That's not what they want to do, which is why I've never been funded. I did have a Darwin X account and I did have a Darwin AI running. And it was running for a good 2 to 3 months before it got flagged. Lucky run. That's all it was. But it didn't fit their portfolio. It didn't fit their risk profile. Go and look at the Darwins that are making money. Average return is 3%, which is brilliant if you've got 100 million quid. But if you've got 100 grand or 10 grand, 3% return, get more than that in the bank. I can't at the moment. Actually, I probably could at the moment because interest rates are through the roof. Yeah, but it's a different thing, isn't it? So they won't like position trading strategies at all. Unless you're using very, 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 very low risk. Yeah, 0.05 risk per half ADR, 3/4 ADR, something like that. And you're going to need to let them run. Yeah, which means that squeezes for 3-4 months. It's just, it doesn't fit. Doesn't fit prop, yeah, because nothing fits prop, does it? But let's face it. Right, that's all I've got for you today. I was going to finish about 2 hours ago, but we seem to be still be talking. So I'll leave it there and get on with my back testing. If there is anything you need, I'll be in Discord or Telegram. Tomorrow I'll be back roughly the same time because tomorrow we've got CPI. So I'll be back on at 1:15 tomorrow afternoon and we'll watch CPI come out and just have a look at all the FX pairs as well to see what's happened. But I doubt whether we'll get an awful lot of movement ahead of CPI, and any movement we do get today probably undo itself before CPI. So anything we've had decent movement today, if you've got an ADR hit, RSI extensions, good chance that they might come back down to where they started before the CPI tomorrow because they're just probably intraday moves. So that is basically the main mover this week. So we will see what happens tomorrow. There's nothing much else overnight. We got wage price index overnight for Aussie, but apart from that, not a lot else. So yeah, we'll see how we go. And if any of these moves actually end up going anywhere. So have a good one. Anything you need, let me know, Telegram or Discord. Otherwise, I'll be back tomorrow afternoon. Have a good evening.